Welcome, welcome. Let's get started. Overall markets are down today. Dow Jones down 0.2%, Nasdaq down 0.9%, led by Nvidia down 6%, S&P 500 down 52 basis points, and Russell 2000 about the same. Um, Before we continue, please let me know if you're watching this on YouTube. Let me know what the audio quality is like. That would really be helpful. If you could please let me know how the audio quality is on X and on YouTube. That would really make it be of huge help. All right. Let's see. There's a big sell-off at 1 p.m. Eastern today, and I just came to the front of my computer. So let's see what the reasoning for that was. Um, okay, sound looks good. Thank you, Henry and Tran, for letting me know. Wall Street stocks dollar steady ahead of tech earnings. That was the morning. It looked steady, but I'm not sure what happened at 1 o'clock. So let's see what happened there. President Trump is considering restricting Nvidia's chip sales to China amid deep-seek competition. Stock falls to a new low of the day, now down almost 7%. So that makes sense. That makes sense. Nvidia has been the cornerstone of this market, and that's a big drop for Nvidia at around 1 o'clock. And this news came out about 1 o'clock, so that makes sense. And then that probably pulled Nasdaq. I think Nvidia is part of the Dow and S&P 500, so that also adds up. And Russell 2000 moved slightly down, but then it recovered. So that makes sense as well, because obviously Nvidia isn't part of Russell 2000. Okay, great. Great, great, great. Microsoft down 1%, Meta down flat, Tesla down 2%. Let's look at how Tesla reacted to the news. Thank you, Kendall, for letting me know. And Henry says, makes a joke on YouTube. All right, let's see. If I look at Tesla stock at 1 o'clock, it looks like it kind of started going down before 1 o'clock, though. So that's weird. Interesting, interesting. Mortgage application index was down 2% today. Um, Oil prices are down 1.5. Yields are about the same. Let's get the 10-year yield. So this is an Nvidia specific event here. Interesting. Interesting. 4:55. We're about to get the 2 o'clock decision by the Fed in about 15 minutes. And then half hour after that, there's going to be a 1 hour press conference, which we're going to listen to together. I think if I can make it happen on YouTube. And then we have the earnings call today as well. All right. For earnings calls, what I do is I have a space open, or actually, I just do it on YouTube. I think on YouTube, um, I do the earnings release, go over the earnings release, and then before the earnings call, we go back and try to kind of read through what happened last quarter, kind of remind us a little bit. Okay, let me look at a couple of things here. Retail inventories, wholesale inventories were down, negative in December. Okay. Okay. NVIDIA says it's ready to work with the US administration as it pursues its own approach to AI. Don't know what that means. RFK Jr. says something in food supply is poisoning Americans. Okay. Durable goods orders declined 2.2%. Core capital goods orders, non-defense excluding aircraft, rose 0.5%. Shipments of these core capital goods rose 0.6%. Both core shipments and orders have been moving higher over the past couple of months, and the level of orders was above shipments in December. Typically a good sign for investment growth. Okay. That's from Double Line. Nvidia shares extend losses after report Trump officials discuss tightening curbs on company sales to China. Yeah, I mean, Nvidia has a lot of problems already, but obviously this doesn't help either. I'm short Nvidia, as you all know. No Fed rate cut before June, says Allianz's Mohamed Alarian. Interesting. That's very ambitious. I mean, if the Fed says there's not going to be a rate, if they signal there isn't going to be a rate cut next meeting, then I think the markets will not take that dovish way. That would be hawkish because I think let's check it in the markets Fed watch real quick. CME Fed watch uh, prices in 99.5% probable to have a pause this meeting, and then March 28% probability of a 25 base point cut and 0.1% probability of 50 base point cut. So this is not yeah, that would not be good for the markets. And there's also a May meeting, and for May markets are basically 50-50. So if there's no rate cut by until June, that wouldn't be good for the markets. So that is Mohamed Alarian's prediction. Expert predicts no Fed rate cut before June. Interesting. There's an edit to this tweet, so let's see what the edit was here. Oh, okay, it's just a spacing thing. Okay. NVIDIA officials held early talks about restricting NVIDIA's H200, H20 chip. Okay. Trump officials discussed tightening curves on NVIDIA China sales. Aggressive. That is very aggressive. You know, um, that's not good. U.S. government worker union sues to block Trump from reclassifying firing thousands of federal employees. OpenAI says DeepSeek may have improperly harvested its data. Okay, whatever. I mean, I don't think that's going to hold up anywhere. Like they've been using everybody else's data, so what's the big deal? You know. We have the Fed decision in about 10 minutes, 12 minutes, and then at half hour after that, we had the press conference that I like to watch. So, um, I mean, I can probably just watch it on my own and then share my notes when we come back again for the earnings call. NVIDIA, Lutnick says China's DeepSeek AI misused American technology. They stole things, they're broken, they taken our IP. Oh my God. Lutnick says he will pursue restrictions to keep United States in lead over China on AI. Oh no. Lutnick says if Canada addressed flow of fentanyl into the United States, there will be no tariff. Okay. CME Group to launch options on Bitcoin Friday futures. Wow. Okay. Where were the signs? Okay, I'm just going through the headlines real quick. Let me see if there's anything here. Nvidia shares extend losses now down 5%. Any questions, comments before the earnings? Request to speak, please. And 10 minutes to the Fed decision. I think that it's going to be a bit more hawkish than people expect, but we'll see. It's going to be a pause, and I think the commentary may be a bit hawkish, but we shall see. We shall see. That's not really a prediction. I think either way, the stocks are overvalued here. It's just that I mean, when I look at a company like Ionic stock is up about 6x in a matter of a couple of months, and this is the quantum computing stocks are the new hype. They're the new GME and AMC stocks, basically. And we're looking at, just among these companies, total tens of billions of dollars of just vaporware market cap, basically, just pure hype. So I just don't know how, if I'm the Fed chair and I see these things and I stay put, I don't know. But we'll see. Inflation has been coming down. Um, people are convinced that it's stuck between 2.5 to 3%. I think he would want to talk those down. So I'm guessing that he's going to make sure that everybody knows in the press conference that they are committed to 2% target and they're going to do what's needed to get there. Um, I think there's some people out there who are hoping that the Fed takes a few years to get there, but I don't think that's the Fed's goal. I think they want to get back to 2%. So we'll see. We'll see what happens. Um, okay, so that's Ionic. There's also an interesting earnings report from a company called Brinker International. Brinker International, the ticker is EAT. Now, I've been looking at the stock as a potential short, but I didn't pull the trigger because I thought it was a little too early to short this company. And today, the stock is up about 20% on good earnings. But today, the company is up about, I think, about 20% good earnings. And it's a really interesting company. It's a Dallas-based company. Um, Let me see what information I can get. They're about 16% today. I think earlier they were up a little higher. $8 billion company. So it's not a large cap. It would be more like a middle cap kind of thing here. It's not a small cap either, but more like a mid cap. But they're growing so fast, which is really interesting to me in this economy. So they own Chili's. I think 90% of the revenues profits come from Chili's, and then they also own Maggiano's Little Italy, and maybe a couple other things. They kind of classify as American multinational hospitality industry company, but I think 90% Chili's. So based in Dallas, founded in 1983. The CEO is kind of new, 2022, which is also interesting. They don't pay in dividends, but they're up. Like, I mean, the stock price is like a rocket. Since September 22nd, they're up 5 times. But they also have fundamentals that are pretty strong. So I'm like, what is going on here? They're growing about 20, 30% top line. The bottom line, net income, is about a couple $100 million. So say 300 million. And so this surge appears to be fundamentally supported, which is very rare to see. So, so I'm not convinced on the short idea yet, but they are. If I see more indications of a recession starting, then this company is on my list to short. So I'm keeping an eye out. The other thing I would want to understand here is what percent of the revenues are coming from Texas area and how geographically diversified they are. But yeah, interesting stuff. Heads for a record close after earnings. Chili's is so back, according to an article here. All right. Yeah, really amazing. I mean, I was not expecting it to go up 20%. Thank God I didn't short the company. RSI over 80. So from a technical analysis perspective, that would mean they're overpriced, overbought. But short interest, 5 million shares. Short ratio, short of float, 12%. There's a short squeeze going on today, that's for sure. 12% short interest. Wow. That's amazing. That's amazing. I mean, I came close to shorting it, but I took one look at it. I'm like, nah, it's not the right one here. Beta 2.5. Man, it's incredible. Um, this short squeeze can go on for a few days actually, because I think the short, yeah, this is really crazy. Let's see. 12% of this company is shorted. Last reporting period, short interest increased from 5 to 5.4 million shares. 17% says. Yeah, this is a massive short squeeze. Wow. Dude, this can go on. Days to cover 6. What? Yeah. So, but I'm on. This is the company EAT going through a short squeeze. I might start a short position sometime in the coming days. If I do, I will tweet about it. But I think it's a little too early. Let me just look at one more thing here. 3 minutes to the Fed decision here, and then we're gonna read about that. Wow. Yeah, this very high volume day, all-time highs. Man, this company can go on for a while. I mean, if I was a trader, I would be looking at this company quite closely here. Anyway, okay, that's that. Let's see. Trump tariff man wants wide-ranging tariffs. Tesla earnings. The new catalyst needed as Trump rally fades. Stock crash, so investors dump more than $900 million into Nvidia. Big mistake. Big mistake. The DeepSeek copycat GPT, Trump advisor thinks so. Okay. Meta to post earnings amid DeepSeek Fed doubt over AI spend. Microsoft set for earnings with AI spend in focus. Waymo to test autonomous driving technology in over 10 new cities. Oh, okay. Let's read that. That's a hell of a news. Tesla. Reuters. Alphabet's self-driving unit, Waymo, announced on Wednesday it plans to expand testing of its autonomous driving technology in over 10 cities in 2025. Um, After testing the Waymo driver in multiple cities, the company says the technology is adapting successfully to new environments, leading to the expansion. In addition to ongoing trips to Truckee, Michigan's Upper Peninsula, upstate New York, and Tokyo, the expansion includes testing in San Diego and Las Vegas, with more cities yet to be announced. During these trips, we'll send a limited fleet of vehicles to each city where trained human autonomous specialists will be behind the wheel at all times, a spokeswoman for Waymo said. The testing will begin with manual driving through the densest and most complex parts of each city. Waymo plans to send less than 10 vehicles to each city where they will be manually driven around for a couple of months, according to The Verge, which first reported the news. In December, Waymo said it is expanding autonomous ride-hailing service to Miami, Florida, adding another city to its operations as it seeks to gain an edge in increasing competitive market. Waymo said October had closed a $5.6 billion funding round. Okay, I see ACDC. Let's bring him up and let's switch to macro. Put on your macro hats real quick. And now we're going to talk about Waymo. Then we have the earnings. So here we go. Seconds to the Fed decision. Tesla is down 2.2% right now. Nvidia stock is down 6%. Amazing. Amazing. All right, here we go. Looks like a pause. Stocks are down a little bit. Nothing too major so far. The market's taking a minute to digest it. Voted 12-0 for Fed funds rate action. Federal Reserve leaves key overnight interest rate unchanged. No dissents. The Fed held the rate steady as widely expected. FOMC statement contains only minor changes that mark to market Recent economic developments. Labor market conditions remain solid. Wow. Okay. Inflation remains somewhat elevated. Okay. I mean, this is a little bit on the hawkish side. So if this is combined with a hawkish conference, I would expect like anything around no rate cut until June. Um, anything about no rate cut on March, like a single no rate cut on March would be hawkish. But this is very much as expected so far, maybe with a tint of hawkishness, because I think labor market conditions are weakening, but the Fed does not recognize that. So the committee decided to maintain the target range for the federal funds rate. Committee's assessment will take into account a wide range of information. The unemployment rate has stabilized at a low level. Okay. In recent months, labor market conditions remain solid. Okay, so they have generally eased, and the unemployment has moved up. So they took that part out, and they say inflation remains somewhat elevated. They took out that has made progress toward committee's 2% objective. Yeah, this is, in my mind, this is hawkish statement. The sentences that are removed recognizes the weakened employment market, and inflation made progress is also removed. So, but the initial market reaction so far seems to be slightly down. I think maybe this people are waiting for the conference call in about half hour. So let's bring in ACDC. ACDC, how are you?
I'm doing well. How are you?
I'm good. I'm good. Any initial takes from this presser? I mean the statement.
Not really. I don't think there's much to read. I mean, you had a couple key points. What I really want to know is, and this will probably come out in the presser, is how they are looking at the cut in government spending. That's something that they've highlighted before that they're going to look at, and I think that's going to be significant from what I'm seeing right now. That is happening. It's happening at a pretty decent pace, more than people had expected. And that's something that the Fed is going to kind of start looking at. So does that change their tone? And in what way? But yeah, the presser is what I'm really looking at.
Okay.
Some of the
My
notes.
guess is that he's gonna say, let's wait and see. Because so far there's a memo, but these things are gonna get challenged in the courts, and it's gonna take several months to play out. So they're gonna want to wait, I think. Jimmy, what do you think? You have a couple of minutes. We're in a tight schedule. Go ahead.
Sure. I don't think this was unexpected. I also don't believe the market sell-off is entirely related to the Fed's rate. I think it is more related to that previous news. It wasn't like the Fed was pushing early rate cuts 2025. They were many times said it was about the data, and they reiterated that it's all about the data.
Yeah. Well, Christopher Waller said that if inflation continues to decline as it has been, then they might cut more in the first half. So I don't think it was off the agenda, completely off the table. And even the CME Fed Watch tool talked about, and it showed about the 30% probability of a rate cut in March. Okay. And then 50-50 for May. So if there is no rate cuts, and if Powell signals no rate cuts in the first half, that is negative for the markets. And my guess right now, okay, this is a pure guess. I'm not a trader. I'm not good at trading, but I kind of sense that the markets are on edge. They are on edge big time. Like they're kind of hanging by a thread off a cliff. Okay, so this presser is very important. The earnings that are going to come out are very important. I see a machine in the crowd. If he wants to come up and waste our time, he's welcome for a minute. ACDC, go ahead.
I completely agree with you that the markets, the sentiment in the market has changed immensely in just 1 week. You could call it the deep seek effect and everything that's coming on after that. And I think the market is a lot more cautious now and looking at everything through a microscope. I also think because of that, what Tesla has to say and offer and I know you'll come to that later, but it's going to be very imperative. This is market is not going to just look at fluff here anymore. They want to see substance now.
That's exactly right. It's about showing some profit growth, and so we'll see. Anyway, we have a lot to talk about. ACDC, go ahead.
No, I'm sorry, that was my fault.
Okay. All right, Machine, why don't you come up and let's talk about Waymo news. Waymo announced they're expanding to 10 cities this year. 10 cities this year. Earlier, we talked about Brinker International showed their tremendous earnings release. Despite going up 6 times, the fundamentals seem to support Brinker International. It was one of the companies on my short list, but I haven't shorted them because I thought it was too early. So the stock is up 20%, going through a massive short squeeze right now. Machine, what do you think about Fed Watch, the Fed statement?
I just saw the notes. Mostly expected. Obviously, they removed the line about inflation kind of on a downward trend. So that is kind of
Progressing.
setting up.
Words matter. Words
Yeah.
very much matter. What they moved was inflation has made progress toward the committee's 2% objective. And instead they said inflation remains somewhat elevated. So that
Yeah.
shows progress. The Fed thinks progress has stalled. Okay.
Yes.
That's massive.
Yeah. And
So I'm adding
depending
to my shorts as Machine talks.
as the press conference obviously is going to have more of an effect of how he talks, and words things. So I think if people expect more rate cuts this year, and there's some indication that there's not going to be, the markets are definitely going to respond negatively. So, I think, it's funny, just big picture, if you think back to a year ago, 2 years ago, when we're watching Trueflation, and you thought inflation was done, right? It was back to zero. You thought it was going to go
I
below
know. I was
zero.
wrong. I was wrong. I was so
And,
wrong. But I
that's
learned.
fine.
So that was 2022. We were doing that, by the way.
Yeah.
And 22 and 2023.
Yep.
And I did think you're right. I thought that we were headed to inflation. I thought that the economy would not be able to sustain these high rates, and I was so wrong. And I even reached out to experts that are in the bond market, and they follow these things so closely, and they have access to tremendous research. And they told me 10-year yield cannot be above 3%. And they were so wrong. I was so wrong. And that's why I invested all of 2023 and 2024 to learn more about macroeconomy. And since then, I've been better. I've been better in terms of my understanding, my predictions. So go ahead, Machine.
Yeah, I'd like to spend more time on just macroeconomics for myself, really get a better understanding. But my question is, I haven't broken down the CPI reports recently, but isn't most of the inflation housing? Like, what other areas are remaining highly kind of chronically inflated?
Yeah. Housing. There's some issues with food, certain food items.
I don't think CPI includes food.
Vehicle. It does. Vehicle inflation has turned up a little bit again. Used car inflation has turned up a little bit, despite rates being so high. Insurance is a big deal, although that's kind of starting to cool down a tad, but that's a big deal. If Tesla insurance was allowed to, go nationwide, I think that would really help, but it's not happening. And I think it's going to be difficult to kind of, home builders have tremendous power. They act a bit like an oligopoly, so that needs to be disrupted for housing inflation to kind of not be a problem. Education is a problem. Education inflation is a huge deal. Healthcare is a big deal. So there's some items that are still problematic, even in 2025. Services like there are people still traveling. You're looking at baby boomers, one of the biggest cohorts in the nation today, and really in multiple countries, and they paid off their mortgages. They are sitting on massive equity in their homes. They're sitting on massive 401k balances. They don't give a fuck about what the interest rate is. They want that European travel. They want to get on that cruise. Did you not see Royal Caribbean stock yesterday when they announced earnings? Record profits. They revised their profit outlook up. This stock is at record prices. That's because your mom and your dad doesn't give a fuck about Powell. They want that travel. So that's the problem. So tell your parents to stop traveling so fucking much. Go ahead.
Coincidentally, my sister and my mom and families are going on a cruise
Yeah.
later
Now
this year.
I know,
They're
it's a
trying to
big
get
deal.
me to take my
Look,
family.
I invested a lot of time into macroeconomics in the last 24 months or so.
Yeah.
And it was such a huge mistake that I ignored it before that. But I have a better idea now. So now, how old is your mom? A boomer or a silent generation?
No, she's a boomer,
Okay.
and she doesn't even have that much money. But it's the same thing. Like, first of all, you have people who have homes and equity, a lot of equity, right? Especially the boomer
They got
generation.
no
So
mortgages. Yeah.
they spend whatever. Whatever they don't have the money, they just take out
Yeah.
a equity loan against it.
Yeah.
And then you have post-COVID sort of like YOLO, people valuing their experiences more. And this has caused some like chronic boom in demand for these sort of services and tourism.
Yep.
More than I expect. I would have expected by 2025 for that to cool off, but I was wrong for sure.
Yeah.
And my question though, and housing, of course, there's limited supply, and there's multiple reasons for why that's not cooling off. It's actually kind of fascinating that even with interest rates being elevated from a few years ago, now for like almost 2 years, housing prices in some markets like the Bay Area have not really corrected. I mean, it's clearly the most expensive time ever. I think even worse than
It's coming. It's coming. It's in
yeah.
the works. It's gonna take a bit more time, but it's in the works.
My question
Jimmy,
to you is,
hold on one second.
Sure.
Jimmy, I saw you posted something in there. We were talking about CPI, and CPI divides into two: core and headline. Core doesn't include food, but the headline does. So you can put your hand down. Machine, go ahead.
my question to you is, of all these categories, which ones do you think are actually influenced the most by increasing interest rates? Because and obviously it depends on the timeline too, because some of
Housing.
these seem like they're just not.
Housing.
Yeah.
Yeah.
But it's
I mean,
just
you
longer
saw
than
the demand plunged instantly, and it's now at the lowest level since 1995. So we're talking 30 years lowest level, despite population growth of about 35%, if I remember correctly. So despite that, I mean, the demand for housing is at rock bottom this year and last year. Now, the problem is the supply is not coming to market. There's not enough supply. And that's because the baby boomers are sitting on their equity. So it is possible that more needs to be done for further supply to come to market, which has shown some, initial signs of kind of increasing, but there is no, there's not enough supply right now for millennials to buy houses.
Yeah, can I add something very important to
Yeah,
this?
go ahead.
I think there's another component to this. Most baby boomers did have kids, if you look at the numbers. Those kids are still alive. So there is a safety net underneath them if anything does happen. So if they're taking out collateralized loans, if they're taking out credit cards, they can live their life even longer than the average life expectancy, depending on those who own homes. Most likely they'll live longer. Now they're getting on Medicaid as well. So those who are getting on Medicare, once they get post-retirement and they're getting Social Security, plus their benefits, and if they have a pension or don't have a pension, plus the collateral from their house if they want to take a home equity loan, underneath all of that are their kids. Machine will always be there if something very bad happens to her. And I know for a fact he is a good son. And this is a very important psychological component. If you didn't have that safety net, if you didn't have kids who are now, like Machine, have jobs and so on and so forth, I think you'd be more worried. She can always reach out to Machine and ask him for something if she wants to make a purchase or she has something going on. Otherwise, the rest is disposable income. Now, this will not be true for other generations. This will be especially true for baby boomers. And the evidence and statistics bear that out.
Thank you. Let me just read a couple more headlines before Machine gets to talk. Unemployment stabilized at low level. Inflation remains somewhat elevated. Voted 12-0, so no dissents. Let's see any other insights. Hawkish messaging by upgrading the labor market, downplaying recent progress on inflation, which is exactly the take we had. This is from Joseph Wang, FedGuy.com. 200,000 followers. Mohammed Al-Arian says, with the removal of the reference to inflation making progress towards its objective, the market's initial reaction is to push yields slightly higher. The focus now shifts to Chair Powell's press conference, in particular, his ability to meet the Fed's desire to avoid making headlines today. Interesting. So I wonder, just because the statement was seen as a little hawkish, I wonder if he's going to be a bit more dovish on the presser. But so that's a possibility. We're going to listen to that. I hope to listen to that together, but I don't know how to do that. ACDC, would you be able to play that for us here?
I'm sorry, I will not.
Okay, Machine, go ahead.
Yeah, it's just funny because now my wife's all of a sudden deciding she wants to buy a house now, and I'm like, I don't know. It's insane. The price to rent ratio is
It's a bad
insane.
time. Yeah, it's a
What?
bad time. It's a bad
Yeah,
time to buy a
yeah,
house right now.
exactly.
Okay, Machine, we have 10 minutes to presser, so let's cover the other topics, and we may have to get off for the presser and then come back after the presser here. Okay, so any final words before earnings today?
You know, I don't know. I can't try to predict anything. I just think if earnings and their projection of, they don't give a clear projection of revenue growth, automotive revenue growth for the year, or even just aggregate growth and earnings, above this sort of expected 20%. I don't know. I think the stock might not react well. I know they're already trying to pump out this idea of, oh, look, we have unsupervised cars around the factory. I think that sort of stuff is not going to fly in terms of positively moving the stock. But it really, obviously the stock's all dependent on more on FSD and clarity on
What
when
do you
they're,
think about FSD supervised on Tesla factory grounds?
that's why I said, I'm like, that's like it's a minor detail for the company. It's a nice, cool thing, I mean, for sure, but it's not fundamentally saving massive amounts of money. It is some proof of concept of an unsupervised car, but it's still not really. So I feel like it's one of those showy things to try to make your earnings report seem nicer.
Okay. Do you expect anything positive?
I mean, energy probably will be quite positive.
Okay.
I would say.
I pinned at the top a link to the YouTube channel, the YouTube video where I'm going to be for the presser. Let's bring in Meta real quick. We have 10 minutes to go for the presser, and then we're gonna watch the presser together on YouTube. There's no way for me to take it to X, so I'm gonna come back after the presser onto the X. But that's gonna start in 10 minutes. So 10 minutes of earnings talk and Nvidia talk. Machine, are you short Nvidia?
No.
Okay. Why not?
Right now I'm not messing with any individual stocks. I just have positions around index funds.
I actually opened up a short yesterday, to be honest.
Bullshit.
No, I did. After that space, I realized maybe I don't know what I'm talking about anymore, and maybe Yaman
Well, the
has a bit of
problem is
understanding.
you probably, with your connections on venture capital or whatever the fuck you do, probably got a wind of this government announcement and thought that was going to be something. But what you're missing is that there's like 5 fucking companies involved in this thing, and they all have their accountants and lawyers and teams and analysts, and word gets out, which explains why Nvidia outperformed the couple of weeks before that announcement. And then everybody sold. It was incredible that the government said, we're going to throw money at you, and the stock did not move. Okay. That's fucking amazing. So that tells me the juice has been squeezed. Every last drop of hype has been baked into the stock at $150 per share. So I'm short. I added to my short a little bit after yesterday's dump. and we'll see what happens. Meta, welcome. Anything on Fed, Nvidia, or Tesla?
Hey guys.
Oh, we can't hear you. Your connection's a little bad. Machine. So Waymo announced they're expanding to 10 cities in 2025. Any thoughts on that?
That's a pretty good ramp, I would say. I mean, I've over time gotten more positive to Waymo's progression, I would say, than I was 2 years ago. So I think it's gonna, there is inertia. There can be inertia in this market of robotaxis. Obviously, there's plentiful demand for these services, and Waymo is nowhere near servicing all that demand, even in one city. But I would say, like in San Francisco, they're all over the place, and they're going to keep growing. And if Tesla is not arriving as a true unsupervised robotaxi in San Francisco in the next year, will that inertia make it harder for them to get market share? You have to at least ask that question and try to address it. So you can't just blow off Waymo anymore.
2-year yield is up 5 basis points right now. Amazing. ACDC?
So I think this is kind of like a positive, the Waymo news for Tesla, because it seems like once they're just ramping up pretty good and they're able to get approvals for these additional cities pretty easily. Now, granted, they've had some track record, but to Machine's point, that it'll be hard for Tesla to compete. I mean, Tesla's cost structure is going to be so much lower, and their fees, their ride per share cost is going to be so much lower. So I don't think that'll be a problem.
Okay, Machine.
Is it going to be that much cheaper? And number two, is this really a race to the bottom? Or right now, what Waymo's able to charge prices, people prefer Waymo over Uber. So, is it something where Waymo may make less money than Tesla would, but still able to make enough to keep growing market share and keep sustaining? That would be my other consideration. But for sure, Tesla should have cheaper cost basis. I just don't know how much does it matter in the short term.
From when I've excuse me, when I've done the numbers, I mean, you're looking at $1.50 minimum for Waymos and Ubers, and even if Tesla comes somewhere 20%, 30% cheaper than that, their margin is significantly higher.
Okay, we can't talk about what's going to happen 5-10 years from now. Another time, we have 7 minutes to the Fed presser. So, any final calls for the earnings release? Troy says that they're going to lose money. Sorry, they're going to miss expectations. Okay, maybe. Who knows? There's a lot of one-time items that can affect. But the bottom line here is this: Troy is very confident that Tesla lost $10,000 per Cybertruck in Q4. Troy says that in Q3, Tesla pushed the Cyber Beast. They kind of accumulated in Q1, Q2, and delivered all of them in Q3 to kind of give the appearance that Cybertruck reached positive gross margin. And they said that. Now Troy says Q4, that's not going to happen. We'll see. Who knows? Cybertruck benefits obviously from the tax credits for battery production. And GM talked about that yesterday, that including those, they reached positive contribution margin on their EVs. And so, maybe Tesla will benefit from that too. We'll see. I don't think that's a material thing. I don't think these government programs, especially just one country for one product, it makes a big difference. It could lead to like a bit of a beat, but if the stock pops on that, I would probably short more. And then Troy also talked about another kind of like interesting tweet that he had was about how the savings over the year, so the cost savings that Tesla does over the years for a given trim. So let's say the Model 3 long range or the Model 3 rear wheel drive, just given trim is very minimal over a 4-year, 5-year period. And he says 5%. I don't think 5% is a minimal amount, but it is also lower than what I thought. And Troy says that if COGS per unit is declining, that's usually because of mix. So the new introduction of a lower trim is what's leading to COGS per unit. And I think that's an interesting observation, and that would be material if true. So, but he knows his stuff, so I would take him at his word. So, couple other things. Let me see. I suspect that there's a chance that Tesla may remove miles traveled on FSD. That chart that they show, FSD miles traveled. There's a chance that they may remove that because it's just not showing what it's not showing good data for FSD take rate or use. So I'm guessing that's going to go away. And then yesterday's space, before, while Meta wasn't here, we talked about machine. Also, you weren't here. We talked about Cruise, Super Cruise from GM's announcement. We went through GM's announcements, and Super Cruise changes lanes on the highway, and they're adding more and more highways, and they're expanding even beyond like minor highways and everything too. So if it can change lanes and you don't need your eyes, I mean, yeah, I think, yeah, you definitely don't need your hands. I know that, but it tracks your eyes. So it's basically like FSD supervised on the highway. So where is the advantage of buying a Tesla because of FSD? Bruce said that after the 3-year they include, I think, 3 years of subscription. After that, the take rate is about 20%, they said. So that's also a very healthy take. I think that's above Tesla's take rate. So that's also interesting. And then what else? Troy says Tesla needs to test driverless FSD with a small fleet, fewer than 100 cars, for a few years before considering mass production of the Robocab. It makes no sense to produce thousands of them if it doesn't work and needs more hardware. He also says the hardware 5 will probably start with the Robotaxi, etc. Okay, just 2 minutes left before the presser, and I definitely want to watch this. We're going to watch this on YouTube together. So the link is at the top of your screens. Any final words? Meta, anything on your end? On Waymo, FSD supervised, unsupervised,
On
Fed?
Waymo, I think everybody who's constantly talking about cost has to accept that prototypes are way more expensive, and the first 700 cars are not going to reflect the cost of the last 10,000 cars. So I think people who are super bullish need to sit down and say, like write down what they think is a insurmountable cost, what they think the sensor suite is like, okay, at this point, it's a huge disadvantage. It can't be that one car is $10 more expensive than the other, and that's why they lose. I
Yeah.
think so. They need to write that down, and then when that time comes, they need to stop repeating it, because Gen 5 to
Okay.
Gen 6 is a 60% sensor reduction.
Okay. Thank you. I want to hear more about that after this presser. Okay. ACDC, any final words? We have 30 seconds left.
No, go ahead. We can come back to this. I just wanted to talk
Okay.
about the gross
All
margin.
right. So this space will stay open, but I'm going to be on YouTube watching the presser. Now we're going to continue in about 45 minutes or so on X. We're going to have another 45 minutes before the earnings release. And then, so we're going to switch all of this. So I highly recommend click into the YouTube link and join me on YouTube now. All right. Talk to you guys in a little bit.
interest rate unchanged and to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. For 2024 as a whole, GDP looks to have risen above 2%, bolstered by resilient consumer spending. Investment in equipment and intangibles appears to have slowed in the fourth quarter, but was strong for the year overall. Following weakness in the middle of last year, activity in the housing sector seems to have stabilized. In the labor market, conditions remain solid. Payroll job gains averaged 170,000 per month over the past 3 months. Following earlier increases, the unemployment rate has stabilized since the middle of last year, and at 4.1% in December remains low. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance. The labor market is not a source of significant inflationary pressures. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.6% over the 12 months ending in December, and that excluding the volatile food and energy categories, core PCE prices rose 2.8%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we are attentive to the risks on both sides of our mandate. Over the course of our 3 previous meetings, we lowered our policy rate by a full percentage point from its peak. That recalibration of our policy stance was appropriate in light of the progress on inflation and the rebalancing in the labor market. With our policy stance significantly less restrictive than it had been and the economy remaining strong, we do not need to be in a hurry to adjust our policy stance. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. We know that reducing policy restraint too fast or too much could hinder progress on inflation. At the same time, reducing policy restraint too slowly or too little could unduly weaken economic activity and employment. In considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We're not on any preset course. As the economy evolves, we will adjust our policy stance in a manner that best promotes our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can maintain policy restraint for longer. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can ease policy accordingly. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. As we previously announced, our 5-year review of our monetary policy framework is taking place this year. At this meeting, the committee began its discussions by reviewing the context and outcomes of our previous review that concluded in 2020, as well as the experiences of other central banks in conducting reviews. Our review will again include outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference in May. Throughout this process, we will be open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. I would note that the committee's 2% longer run inflation goal will be retained and will not be a focus of the review. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer run inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Steve.
Mr. Chairman, Steve Leisman from CNBC. Mr. Chairman, at a event in Davos, or to Davos anyway, the president said he'll demand that interest rates drop immediately. So I guess I have a three-part question. Has the president done this to you? Has he made that demand? Secondly, what is your response to that? And third, what effect, if anything, if any, does a president making these kind of remarks have on policy? Thank you.
Three questions. I'm seeing it really as one question, though. So I'm not going to have any response or comment whatsoever on what the president said. It's not appropriate for me to do so. The public should be confident that we will continue to do our work as we always have, focusing on using our tools to achieve our goals and really keeping our heads down and doing our work. And that's how we best serve the public.
Can you just comment on whether he's physically communicated this demand to you?
I've had no contact.
Thank you.
Thanks.
Nick.
Nick Timmeros, The Wall Street Journal. Chair Powell, you and several of your colleagues said around the time of the last meeting that your policy stance was meaningfully restrictive. Given economic and financial market developments since then, how has your confidence changed in an assessment that says interest rates are meaningfully restrictive?
I don't think that my assessment really has changed. I mean, a couple of things have happened. We've gotten more strong data, but we've also seen rates move up at the long end, which could represent a tightening in financial conditions. I think if we look back over the past year or so, we can see that policy is restrictive. If you look at the effect of high rates on interest-sensitive spending, for example, in housing, and if you look at the achievement of our goal variables, we're seeing the economy move toward 2% inflation and has moved largely to maximum employment. So we really look at the movement toward the goal variables to make that assessment. Now, policy is meaningfully less restrictive than it was before we began to cut. It's 100 basis points less restrictive, and for that reason, we're going to be focusing on seeing real progress on inflation, or alternatively some weakness in the labor market before we consider making adjustments.
If I could follow up, does the economy here warrant meaningfully restrictive interest rates? And would you judge interest rates to still be meaningfully restrictive if you were to lower them by another quarter point?
So I think our policy stance is very well calibrated, as I mentioned, to balance the achievement of our two goals. We want policy to be restrictive enough to continue to foster further progress toward a 2% inflation goal. At the same time, we don't need to see further weakening in the labor market to achieve that goal. And that's kind of what we've been getting. The labor market has really been broadly stable. The unemployment rate has been broadly stable now for 6 months. Conditions seem to be broadly in balance. And I'd say look at the last couple of inflation readings and you see we don't overreact to two good readings or two bad readings, but nonetheless, the last couple of readings have suggested more positive readings. So I think policy is well positioned.
Colby from the New York Times.
Colby Smith with the New York Times. Chair Powell, how should we interpret the removal of the line from the statement that inflation has made progress towards the 2% goal? Is that no longer the case?
No. So let me look. If you just look at the first paragraph, we did a little bit of language cleanup there. We took out a reference to since earlier in the year as it related to the labor market. And we just chose to shorten that sentence. Again, I mean, if you look at the sort of intermeeting data, it was good. And there was another inflation reading, I guess, just before the December meeting. So we've got two good readings in a row that are consistent with 2% inflation. Again, we're not going to overinterpret two good or two bad readings, but this was not meant to send a signal. Other than this, you can take away from all of this that we remain committed to achieving our 2% inflation goal sustainably.
And just to follow up, we've seen inflation expectations across a number of measures rise sharply, which has in part been linked to tariff concerns. But there's also been this encouraging data that you mentioned in terms of CPI and rent indices. So how would you characterize concerns about upside risks to inflation across the committee, especially those tied to policies related to the Trump administration?
Well, I'd say you see expectations moving up a little bit at the short end, but not at the longer end, where it really matters. And those could be related to what you mentioned, some of the new policies. I think where the committee is very much in the mode of waiting to see what policies are enacted. We don't know what will happen with tariffs, with immigration, with fiscal policy, and with regulatory policy. We're only just beginning to see, actually are not really beginning to see much. And I think we need to let those policies be articulated before we can even begin to make a plausible assessment of what their implications for the economy will be. So we're going to be watching carefully, and as we always do, this is no different than any other set of policy changes at the beginning of an administration. We'll patiently watch and understand, and kind of not be in a hurry to get to a place of understanding what our policy response should be until we see how it plays out.
Michael McKee.
Michael McKee from Bloomberg Television and Radio. You and your colleagues normally condition future policy moves with the phrase, if the economy develops as we anticipate. Is it fair to say that since there's a lot unknown about what this administration's fiscal policies are actually going to be, that you don't have a medium to long-term economic forecast that you can have confidence in? Or if that's not true, can you lay out what you think is going to happen in the economy, how you see it developing?
Well, at all times, forecasts are conditional at a minimum on just a set of expectations, and they're highly uncertain in both directions. We know that economic forecasting is really difficult beyond just a month or two out. So in the current situation, there's probably some elevated uncertainty because of significant policy shifts in those four areas that I mentioned: tariffs, immigration, fiscal policy, and regulatory policy. So there's probably some additional uncertainty, but that should be passing. We should go through that, and then we'll be back to the regular amount of uncertainty. So, what forecasters are doing, not just us, but everybody's doing, is they've got sort of just a set of assumptions about what might happen, but they're really kind of in the nature of a placeholder, and meaning, plausible could be, but honestly, you wouldn't stand behind it because you just don't know. And so you're just on hold waiting to see what comes down. It's a very large economy, and policies affected at the margin, but we're going to wait and see.
If I can follow up, the idea that you feel the economy, that policy is restrictive, suggests that the Fed in general wants to continue to lower interest rates. So when you look at the data that you are dependent on, are you looking for data that tell you that you can cut, or data that will tell you you should hold?
We're looking. It's more the other. The way it works is we are looking at the data to guide us in what we should do. And, that's what we do. And right now, we feel like we're in a very good place. Policy is well positioned. The economy is in quite a good place, actually, as well. And what we do expect is to see further progress on inflation. And, as I mentioned, as we see that, or if we were to see weakening in the labor market, that could foster, we could then be in a position of making further adjustments. But right now, we don't see that, and we see things as in a really good place for policy and for the economy. And so we feel like we don't need to be in a hurry to make any adjustments.
Howard.
Howard Schneider with Reuters. Thank you very much. In 2021 at a central bank conference, you said, quote, throughout my career in both public and private sectors, I've seen that the best and most successful organizations are often the ones that have a strong and persistent commitment to diversity and inclusion. These organizations consistently attract the best talent by investing in and retaining a world-class workforce. First question is, do you still believe that? And if so, how do you intend to put that belief into practice while remaining consistent consistent with the recent executive order prohibiting diversity and inclusion efforts?
So let me say yes, in answer to your first question. But to the second question, I want to say this. We are, like others, we're reviewing the orders and the associated details as they're made available. And as has been our practice over many administrations, we are working to align our policies with the executive orders as appropriate and consistent with applicable law. And I want to add that I'm not going to have anything more specific for you today on this whole set of issues.
Well, if I could just follow up quickly on that. I'm wondering how you're getting that to be consistent with the Dodd-Frank law's stipulations about maintaining an Office of Minority and Women's Inclusion.
So I did mention consistent with applicable law, right?
Which is governing.
Elizabeth. Thanks so much. Elizabeth Schulze with ABC News. Just to follow up on Steve's question, what reassurance can you give the American public that the Fed will continue to operate independent of politics under this administration?
You know, as I've said countless times over the years, this is who we are. This is what we do. We study the data. We analyze how it will affect the outlook and the balance of risks, and we use our tools to try to, given our best understanding, our best thinking, try to achieve our goals. That's what we do. That's always what we do. Don't look for us to do anything else. And that's, you know, lots of research shows that's the best way for a central bank to operate. That'll give us the best possible chance to achieve these goals for the benefit of the American people. That's always what we're going to do. And people should have confidence in that, as I said a few minutes ago.
You've said that the Fed is in wait and see mode based on the policies that come out of this administration. Has the Fed started to model what policies like mass deportations, changes in immigration policy specifically, would look like for the workforce and for inflation?
So one of the things our staff does is they look at a range of possible outcomes, and they tend to go from really good to really bad, and you know it's one of the best things that they do. And in each teal book, you can look at the 5-year-old teal books and see their alternative simulations. So that's what they do. You'll be a baseline, and then they'll show 6 or 7 alternative scenarios, including really good ones and not so good ones. And what those do is they spark, you know, the policymakers to sort of think and understand about the uncertainties that surround this. So yes, the staff does that, and we're all well aware that the range of possibilities is always broad, and not just now but always. And it's hard to be open to just how broad the possibilities are for an economy. You know, no one saw the pandemic coming, and it was, you know, it changed everything. So things happen, and but yes, we do that. But it's different. It's one thing to do that, to make assessments about what might happen and begin to think about what you might do in that case. But you don't act until you see much more than we see now.
Katarina.
Katarina Saraiva, Bloomberg News. You know, last month you talked about a future rate cut as being pretty, you know, significantly predicated on more progress in inflation. With the characterization of the labor market in the statement today, would you say that that's even more so the case now?
I'd say it's the same. You know, we want to see, you know, further progress on inflation, and you know, the story's there. We're just going to have to see the data. At the end of the day, it comes down to 12-month inflation, because that takes out the seasonality issues that may exist. And, you know, we're just going to need to see that. We think we see the pathway for that to happen. One example, a key example, is that you now do see owner's equivalent rent and housing services, the way it's calculated for PCE. You see that coming down pretty steadily now, and that's the place where most of the remaining gap is. In addition, a big part of the overrun, as you will know, was from non-market services, which don't tend to send much signal. So you can look through all that and think, okay, that then we seem to be set up for further progress. But being seemed to set up for it is one thing, having it is another. So we're going to want to see further progress on inflation. But remember, we're not, we're under 2%, but our goal is 2%, and we do mean to get back sustainably to 2%.
And in terms of the labor market, I mean, how is that broadly, you said a broad set of indicators show that it's in pretty solid place. Was there broad agreement on that? There's been a few underlying indicators that are showing perhaps some weakness, a low hiring rate, workers reporting that it's increasingly difficult to find a job. Is that of concern to the committee?
So you're right. I mean, we look at, of course, a very broad range. So it starts with unemployment, with the unemployment rate, employment participation, wages, job quits, are people quitting, that kind of thing. The ratio of vacancies to unemployed. We look at all those things, and you put your finger though on it's a low hiring environment. So if you have a job, it's all good, but if you have to find a job, the job finding rate, the hiring rates have come down, and that's more typical of a. Let's say that the unemployment, that the labor market is at a sustainable level. It's not overheated anymore. We don't think we need it to cool off anymore. We do watch it extremely carefully. It's one of our 2 goal variables. But I'd say we watch those things quite carefully. But nonetheless, overall, look at the aggregate data in the labor market. The labor market does seem to be pretty stable and broadly in balance when you've got an unemployment rate that has been pretty stable now for a full half a year.
Edward.
Thank you. Thank you, Mr. Chairman. Edward Lawrence with Fox Business. On employment, now you said there's a broad range of possibilities, but last September you said, quote, "We understand that there's been quite an influx across the borders, and that has actually been one of the things that's allowed unemployment rate to rise." Now that the flow of the border has slowed and we're seeing deportations, how do you expect the unemployment rate to react?
So what's happening is that the flows across the border have decreased very significantly, and there's every reason to expect that to continue. But job creation has come down a bit too. So, if those 2 things come down together, that sort of can be a reason for the unemployment rate to stabilize. In other words, the break-even rate, as population growth slows, the break-even rate that you need in new jobs to make make jobs for workers declines as well. So that seems to be something about what's happening. You do see a very flat unemployment rate at a time when you've seen significant declines.
I want to ask you about Fed employment. I know that tax money is not used here, but Elon Musk alleges that the Fed is, quote, absurdly overstaffed. We've seen the executive branch push to reduce the federal workforce. I just want to get your reaction.
We run a very careful budget process. We're fully aware that we owe that to the public, and we believe we do that. I've got no further comment than that. Thanks.
Chris.
Chris Rugaber at Associated Press. President Trump has said he will lower inflation by reducing gas and energy costs. Do you see such costs as a particular driver of inflation, and would lowering them have a dramatic effect?
Chris, I'm not going to react or discuss anything that any elected politician might say. So I'll give you a mulligan.
Okay, thank you. Well, nearly 2 weeks ago, the Fed said it was withdrawing from the network for greening the financial system, even as we have significant wildfires in Los Angeles doing billions of dollars in damage. And of course, the NGFS, as you know, is a group to talk about how the financial system could address climate change. Many commentators did see the timing as political. Why did you leave that organization? Can you explain that decision?
Sure, I'd be glad to. So we considered this, really at length, and we did decide to withdraw from the NGFS. And really the reason is that the work that the NGFS does has broadened very significantly. Think about nature-related risks and biodiversity and things like that. In addition, the work of the NGFS is in significant part intended to, and this is a quote, mobilize mainstream finance to support the transition toward a sustainable economy. So we joined to get the benefit of understanding what other central banks were doing and seeing research and things like that. I think this is just way beyond any plausible mandate that you could attribute to the Fed. And so we have a quite narrow role, as I've said many times. And I think that the activities of the NGFS are not a good fit for the Fed, given our current mandate and authority. So, and I just think it was time to acknowledge that, this process dates back a couple of years. I made the decision to bring this to the board, some months ago. It just the process just took time to get here, and this is when we got it and voted on it. So, and I'm aware of how it can look, but it was really not driven by politics. It was driven by kind of the disconnect between the work of the NGFS and our mandate. Other central banks have different mandates and belong to the NGFS. We have no criticism of them, but it just isn't. It's not right for the Fed.
Andrew.
Thanks, Andrew Ackerman with the Washington Post. I'm wondering if you could talk more about what further progress would look like for consumers.
Well, 2% inflation down to 2% sustainably is what we're trying to achieve. You know, we're somewhat above that, as you know, and you know we want to see serial readings that suggest that we're making further progress on inflation. That's what we want to see, and consumers will pick that up, of course, in the things that they buy at the grocery store or at the store.
The other thing I wanted to ask was just how far away you think you are from neutral.
Yeah, you can't know with any precision, of course, as I like to say, that you know the neutral rate by its works. So I think at 4.3%, we're above pretty much everyone on the committee's estimates of the longer run neutral. I think our eyes are telling us that our policy is having the effects on the economy. That's really the question we ask. You can consult models, empirical models, theoretical models. You really have to just look out the window and see how your policy rate is affecting the economy. And I think we see that it's having meaningful effects in bringing inflation under control. It has helped bring the labor market into balance as well. So that's what we think. I would say we're meaningfully above it. I have no illusion that anyone knows precisely how much that is. But not knowing that and having cut 100 basis points means that it's appropriate that we not be in a hurry to make further adjustments.
Victoria.
Victoria Guido with Politico. So as a general matter, when it comes to executive orders and OMB memos, do those always apply to the Fed, sometimes never, or do you just often voluntarily comply? What is the legality there?
So it's been our practice, as I mentioned, to work to align our policies to those that are mentioned in the executive orders, and I'm just going to leave it at that. As I mentioned, I'm not going to go any deeper than that or get into any deeper into this set of issues today.
Claire.
Claire Jones from the Financial Times. Two questions, if I may, on tariffs. Well, first of all, we've seen global trade wars before, notably in 2019, last time around, but then we were in a very different place on both inflation and growth. If we see tariffs of the same sort of magnitude that we got then, which I know is big if, what do you think might be different this time around? And secondly, Tiff Macklem said there was no doubt that the threat of tariffs was a big driver of the cut by the Bank of Canada today. What sort of information would the Fed need to see on tariffs before it was willing to take such a preemptive move? Thank you.
Sorry.
What sort of information would you need to see on tariffs? Would you need to see a strategy, actual implementation, actual movement of inflation expectations before you're actually willing to change the path of monetary policy on the basis of it?
Yeah, so first of all, things are a little different now. We've just come through a high inflation period, and you can argue that both ways. You can say that companies have figured out that they do like to raise prices, but we also hear a lot from companies these days that consumers have really had it with price increases. And so I don't know how that shakes out. Nonetheless, you're coming through a situation where we're not quite back to 2%, and that's just different. In addition, the kind of footprint of trade has changed a lot as trade is now spread around. It's not as concentrated in China as it was. There was a lot more manufacturing. It moved to Mexico and other places. So there are differences, and I just think the range of possibilities is very, very wide. We just don't know, and I don't want to start speculating, as tempting as it is, because we really don't know, and we didn't know, by the way, in 2018, we didn't really know. And again, the range of possibilities very, very wide. We don't know what's going to be tariffed. We don't know for how long or how much, what countries. We don't know about retaliation. We don't know how it's going to transmit through the economy to consumers. That really does remain to be seen. There are lots of places where that price increase from the tariff can show up between the manufacturer and the consumer. Just so many variables. So we're just going to have to wait and see. And the best we can do is what we've done, which is study up on this and look at historical experience, read the literature, and think about the factors that might matter. And then we'll just have to see how it goes.
Courtney. Thank you, Courtney Brown from Axios. Two unrelated questions. The first is whether or not there was any discussion about QT and the timeline for ending QT at this meeting. And then the second question is just, I wonder if the AI prompted sell-off in the stock market this week signaled anything to you about the state of financial conditions?
So let's talk about runoff. So the most recent data do suggest that reserves are still abundant. Reserves remain roughly as high as they were when runoff began, and the federal funds rate has been very steady within the target range. We track a bunch of metrics, and they do tend to point to reserves being abundant. We do intend to reduce the size of our balance sheet to a level that's consistent with implementing monetary policy efficiently and effectively in our ample reserves regime. We're closely monitoring a range of indicators to assess conditions, and that should provide signals whether reserves are approaching a level that could be judged as, quote, somewhat above ample. I don't have anything to say to you about particular dates. It's just that's the process, and what we see is that the rates do appear to be abundant. As always, we stand ready to take appropriate action to support that smooth transition of monetary policy, including to adjust the details of our approach for reducing the size of the balance sheet in light of economic and financial developments. On AI, it's a big event in the stock market and in particular parts of the stock market. I mean, what really matters for us is macro developments, and that means substantial changes in financial conditions that are persistent for a period of time. So I wouldn't put that label on these events, although, of course, we're all watching it with interest.
Simon.
Simon Urbanovich with The Economist. Thank you. You mentioned in your remarks that activity in the housing sector seems to have stabilized. At the same time, since your first rate cut in September, long-term mortgage rates have gone up by a full percentage point back above 7%. I'm wondering, kind of looking forward, are you confident that activity will remain stable given how elevated mortgage rates are? How does it fit into your broader thinking about the economy?
So, as you know, as we've reduced our policy rate 100 basis points, longer rates have gone up, not because of expectations, not principally because of expectations about our policy or about inflation. It's more a term premium story. So, and it's long rates that matter for housing. So I don't think, I think these higher rates are they're probably hold back housing activity to some extent if they're persistent. We'll have to see how long they persist. So, we control an overnight rate. Generally, it propagates through the whole family of asset prices, including interest rates. But in this particular case, it's all happened at a time when, for reasons unrelated to our policy, longer rates have moved up.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said you want to see further progress on inflation. Given that households appear to be unhappy with the elevated level of prices, do you believe the committee should wait until inflation has fallen back to target to cut rates again?
No, I wouldn't say that. We've never said we need to be all the way at target to reduce rates. At any time, what we're doing is we're looking at the economy and asking whether our policy stance is the right one to achieve maximum employment and price stability. So I think if we would want to see further progress, but we think our as I mentioned, we think that our policy stance is restrictive, meaningfully restrictive, not highly restrictive, but meaningfully restrictive. And so I would think we need to see further progress. I wouldn't say all the way back down to 2% on a sustainable basis, although we'd love to see that, of course, and we will.
And a separate question for you on tariffs. Curious whether the threat of tariffs and not knowing whether they could stick or not creates uncertainty for business here in the United States and could cause them to pull back, ultimately weighing on growth. Does the threat of tariffs cause you to ponder your growth forecast?
You know, I want to avoid commenting even indirectly on the conduct of tariffs. You know, it's not our job, and it's not our job to comment on the moves that people make. So I wouldn't want to criticize anything that's happening or really comment on it one way or another, praise it for that matter. It's just not our job. I do think that, you know, we found in 2018, there was a lot of work done on trade policy uncertainty. Trade policy uncertainty, if it's large and persistent, can start to matter for businesses making investment decisions and things like that. That's not something I'm observing today. It's very early days for this, but I think that did matter in 2018-19, and it's one of many things we'll be watching.
Matt.
Thank you, Chair Powell. Matt Egan from CNN. Following up on Courtney's question from earlier about the stock market, how concerned are you, if at all, about potential asset bubble brewing in financial markets? How do relatively high market valuations factor into considerations about potentially lowering interest rates further? Is that something that's in the back of your mind?
So we look at, from a financial stability perspective, at asset prices generally, along with things like leverage in the household sector, leverage in the banking system, funding risk for banks and things like that. But it's just one of the four things asset prices are. And yeah, I'd say they're elevated by many metrics right now. A good part of that, of course, is this thing around tech and AI. But we look at that. But you know, we look at how resilient the households and businesses and the financial sector are to those things. So we look at that mainly from a financial stability perspective, and we think that there's a lot of resilience out there. Banks have high capital, and households are actually overall, not all households, but in the aggregate, households are in pretty good shape financially these days. So that's how we think about that. We look at overall financial conditions, and you can't just take equity prices. You've got to look at rates too, and that represents a tightening in conditions with higher rates. So overall, financial conditions are probably still somewhat accommodative, but it's a mixed bag.
Richard.
Hi, Chair Powell. I'm Richard Escobedo with CBS News. One question for you. This month's statement notes that unemployment has stabilized at a low rate and that the labor market is solid. You walked through some of what's driving this, but I wonder what risks you see that might challenge your assessment.
Well, the things we discussed earlier, one is that there's a low hiring rate. And so that if there were to be a spike in layoffs, if companies were to start to reduce headcount, you would see unemployment go up pretty quickly because the hiring rate is quite low. So that's one thing we look at. I think it's worth pointing out that for lower income households, they're under significant pressure. And in the aggregate, the numbers are good, but we know that people at the lower end of the income spectrum are struggling with costs. And really, it's high inflation for the basics of life. It's not so much the inflation now, it's the price level, because inflation has raised prices. Inflation is now much closer to target, but people are really feeling that. But overall, this is a good labor market. You're at 4.1% unemployment. That's just a really good level, and you've been solidly there now for 6-7 months. And job creation is pretty close to a level that will hold the unemployment rate there, given that there'll be much slower population growth.
One more question. Some of the uncertainty around immigration policy is, in your assessment, is that making it harder for businesses and the Fed to plan going forward?
We hear anecdotal reports, but I don't see it. There's nothing in the data yet on that. But you hear that kind of thing about construction, for example, and businesses that are dependent on immigrant labor are saying that it's suddenly gotten harder to get people. But I know you don't see that in the aggregate data yet, but yes, you hear it anecdotally.
Nick.
Thank you, Chair Powell. Nicholas Jasinski from Barron's. The uncertainty is certainly a theme today, and I'm wondering, are there any periods from your career or as it relates to markets, the economy, what's going on here in Washington and beyond, or from lessons from history that may provide some guidance for a central banker operating in uncertain times like today?
I guess I'd say this, uncertainty is with us all the time. It is human nature, apparently, to underestimate how fat the tails are in a way. The possibility, we think of things in a normal distribution, and in the economy, it's not a normal distribution. The tails are very fat, meaning things can happen way out of your expectations. It's never not that way. I wouldn't, if you think about it, think about the first few months of the pandemic. That was uncertainty. Are we going to be able to reopen the economy? If so, when? How much of it? How long will it take? That was uncertainty. What we have now is a good labor market. We have the economy growing at 2 to 2.5%. Inflation's come down to now the headline inflation number was 2.6, and that's what the public experiences. We look at core because it's a better indicator of future inflation. So yes, the price level went up a lot for inflation, and people are feeling that, and they're not wrong. But so the kind of uncertainty we have is just a usual level of uncertainty about the economy, but then policies which are not for us to criticize or praise, really. Those are policies which people have been elected to implement. They're implementing them with a view to making a better economy. And so I wouldn't call this out as one of those times. I wouldn't compare it to the global financial crisis or anything like that, given that we have actually a very good economy right now.
Evan Reiser with Market News International. Chair Powell, is a March cut still on the table? And then additionally, are you looking to see better than expected data on inflation to cut? Or are you looking for inflation data that roughly aligns with current forecasts?
So as I mentioned, the economy's strong, the labor market's solid, downside risks to the labor market appear to have abated, and we think disinflation continues on a slow and sometimes bumpy path. That tells me, and the other members of the committee, the broad sense of the committee actually is that we don't need to be in a hurry to adjust our policy stance. Your second question was?
Whether or not you need to see better than expected inflation data or just inflation data that roughly aligns with your current forecasts.
It's one of those things, we'll know it when we see it, but more the expectation is that we will make continued progress. And, that's what we want. We'll know it when we see it. It's going to have to be something that isn't just idiosyncratic. You're going to want to see, continued progress with housing services inflation. You're going to want to see inflation behaving in a way that builds confidence that we are really making progress. That's what it's going to be. And I mean, is that better than our expectations? We expect to see that. It's just a question of when.
Scott.
Hi, Chair Powell, Scott Horsley from NPR. In your 5-year review, you said the 2% inflation target won't be on the table. Can you talk a little about why? Is that because you think that's the right target, or is it because you don't want to move the goalpost mid-game, or what's behind that?
I think that goal has served us well over a long period of time. It's also the sort of global standard. I think that if central bank wanted to look at changing that, you wouldn't do it at a time when you're not meeting it anyway. I would not look at changing it anyway, but I certainly wouldn't look at it at a time when you're not meeting it. I mean, there's just no interest at all in changing it. If I'm being at all unclear, we're not going to change the inflation goal anytime soon.
And 5 years ago, if I can paraphrase what y'all decided, it was you're going to not raise interest rates preemptively to head off inflation until you see sort of the whites of the eyes of inflation, because the solid labor market was so beneficial. Have the last few years changed your thinking about that?
So what we really said was that we wouldn't look at a strong labor market and raise rates unless we saw some evidence of inflation. So the thought was that we'd seen really low levels of of unemployment with no sign of inflation. So why would you preemptively want to put people out of work in the absence of any kind of any evidence that suggested that this was not a sustainable level? It was a way of acknowledging how much humility we have about the starred variables, especially U-star, the natural rate of unemployment. So that was an insight. We'll discuss that again. That'll be one of the many things that we discuss. But I don't think that insight is wrong. We didn't, we said what we said was that, at times when inflation persistently undershot 2%, we would likely allow inflation to run moderately above 2% for some time. That's what we said. That turned out not to be relevant to what actually happened. There was nothing moderate about the overshoot. It was an exogenous event. It was the pandemic, and it happened. And our framework permitted us to act quite vigorously, and we did once we decided that that's what we should do. The framework had really nothing to do with the decision we looked at the inflation as transitory, and right up to the point where the data turned against that. And when the data turned against that in late 21, we changed our view and we raised rates a lot. And here we are at 4.1% unemployment and inflation way down. But the framework was more irrelevant than anything else. That part of it was irrelevant. The rest of the framework worked just fine as we used it, as it supported what we did to bring inflation down.
Let's go to Mark for the last question.
Hello, Chairman Powell. Mark Hamrick with Bankrate. As you know, in the annual report from the Financial Stability Oversight Council, among the risks outlined is cryptocurrency. Could you talk about those risks now? And regarding individuals and households, perhaps distinct from the concern about the financial system, do you worry that speculation in this unregulated asset class could hurt their financial well-being, or do you think it has a place in a household's portfolio?
So our role with Bitcoin really is to look at, with crypto, really is to look at the banks, and we think it's, banks are perfectly able to serve crypto customers as long as they understand and can manage the risks, and it's safe and soundness. A good number of our banks that we regulate and supervise do that. The threshold has been a little higher for banks engaging in crypto activities, and that's because they're so new, and we don't want to make the mistake. If you're making a choice to conduct that activity inside a bank, which is inside the federal safety net with deposit insurance, then you want to be pretty sure that it's a safe and sound activity. So, we're not against innovation, and we certainly don't want to take actions that would cause banks to terminate customers who are perfectly legal just because of excess risk aversion, maybe related to regulation and supervision. So.
And with respect to households and their inclusion in that asset class?
That's kind of it's not really our bailiwick. You want people to be knowledgeable about the financial engagements that they have, and that's why we have the securities laws that we have. It's why if you read a mutual fund prospectus or individual stock prospectus, you want households to have the chance to understand the risk that they're taking. And I do think it would be helpful if there were a greater regulatory apparatus around crypto, and I think that's something Congress was working on quite a lot. We've actually spent a lot of time, with members of Congress working together with them on various things, and I think that would be a very constructive thing for Congress to do. Thank you. Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state and remains solid. Inflation has eased substantially from a peak of 7% to 2.1% as of September. We are committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. Today, the FOMC decided to take another step in reducing the degree of policy restraint by lowering our policy interest rate by 1/4 percentage point. We continue to be confident that with an appropriate recalibration of our policy stance, strength in the economy and the labor market can be maintained, with inflation moving sustainably down to 2%.
All right. Welcome back, everybody. Welcome back. Let me know how the audio is on YouTube. Let's continue with our conversation. We have half hour to go, 40 minutes to go to the Tesla earnings release. And let's do a quick recap of the Fed presser. I see Meta. Let's bring him up. Please let me know how the audio is on YouTube. Meta, how are you?
Good, good. Maybe not in this space, given so many events are happening today, but it would be interesting to do a deep dive onto analysis of the executive order around cryptocurrencies and how the Fed statements today might give us some insights on what they're going to do.
Okay, sounds good. What was the executive order on crypto?
I'll send it to you. There's a executive order. There's 5 parts to it, and we could just go part by part.
Okay. Did you watch the presser at all or no?
I did. Sorry, I can't unmute when I'm trying to send you a message.
No, you don't have to send it to me right now. What did you think of it? What did you think of the presser?
I think the most interesting part was when they said, "Why did you delete this line?" And he said, "We just cleaned up the text at the front part."
Right.
People are so obsessed with every line.
Yeah. Yeah.
He's like, "Look, we
Yeah.
just trying to make this thing shorter."
I mean, they must have known that people are going to interpret that as hawkish, which is what we did here too. And but I did say that in the conference he might be more dovish because they don't want to make headlines. So
That line just says, "We're going to do our job." It kind of seems ridiculous to keep saying, "We're going to do our job."
right. Yeah, they are definitely focused on getting the inflation down to 2%. All right.
My
Not much of
signal
a
cut.
Go
My
ahead.
signal cut out for a bit. Is the PCE 1.8 or 2.8? I only got the 0.8 part.
Yeah, I usually watch these things again tonight. So I'm going to watch it again tonight. I didn't catch that part, but the PCE right now, give me 1 second. I don't think I mean he might be talking about core PCE. He might be talking about some annualized rate.
It was
So I don't know
core.
what
It was
it's core.
core.
Okay. Okay.
Yeah, he was saying the other one was over 2 handle, and then the other one, I'm assuming, is always lower, right?
Yeah, it might have been some sort of like a annualized rate too. We can't get to that. But inflation is elevated, they said, so they still don't see the work as being done. And after this presser, the probability of a rate cut in March has declined and embedded markets as well. So the market is taking this as a bit more hawkish than usual. So, but it's not too different from expected. So right now, the probability of a rate cut in March is about 20%. Yesterday it was 22%. Yesterday it was 31%, but a week ago it was 25%. So pretty unchanged. And then in May, probability of a rate cut is about 38% for 25 and 6% for a 50 basis point cut. So that's lower again by about 5%, 10% yesterday, but similar to last week. So this is very much as expected. And the markets have recovered after he said we were just trying to clean up the text, basically, like you said. So they didn't intend to give a signal there.
Yeah, there's people saying that the Fed is claiming they're not going to cut in March. I don't see anything in the conference where he actually says that.
No, he did signal something. Give me 1 second. When he was asked, let me see 1 second, because I did kind of highlight that as a potential thing to look for. He said it was a question about a March cut, and he said the broad sense of the committee is that we don't need to be in a hurry to adjust our policy stance. So they're not going to cut in March unless something major happens. Okay, they're not going to cut in March unless something major happens. He was also asked about this Nvidia. What did you think of his answer there? He said something along the lines that, what did you think of his answer? He got asked twice about the AI related route in the markets.
I'm not gonna lie, my internet was choppy, and I didn't. I would have retained that, and I need to go back and watch that.
Yeah. I mean, I knew he was going to get asked this question, and he was asked, basically, how do you think about the market events like that? And because that was a very significant event. I mean, that was a very significant event. The biggest company in the world lost $600 billion, or at least in the publicly traded markets.
Who could have seen that coming?
Right, exactly. I don't think anyone saw a 20% drop, in 1 day or 2 days, I guess.
I didn't see it in a day or two, but do recall I said there will come a day and it could drop 50%. We're not there yet.
Right. I mean, I did think that it was. I mean, the pre-market action was pretty insane that day. Like a couple of days ago on Nvidia, the pre-market action was
Yes.
pretty insane. It was so interesting, like one of those kind of like movies that you watch that you don't want to stop watching. And I lost sleep. I couldn't sleep that day. And then, and if you listen to the space the day after, I'm like, you can tell I didn't get my sleep the night before.
I think it's just bad because it's not that Nvidia is doing any worse as a business. Like as from a fundamental standpoint, I think they're still a good business. There's still going to be a ton of inference compute. The market is somewhat overreacting in that sense. If the market wanted to continue to give the premium they were giving a week ago and they fully understood what they were giving a premium to, nothing has changed. Problem is the market doesn't really understand what they're giving a premium to.
Yeah, I disagree with you on that. I disagree with you. I don't think. I think the fundamentals of the company is actually pretty weak. I don't think it's a.
We're in the same boat. I was saying if the premium they were giving knowledgeably, then yeah, I agree with you. I don't think that they warrant the premium in the first place.
What do you think is the fair value of Nvidia? Today it's trading at just above $3 trillion. What do you think is the fair value of Nvidia?
I don't have a good DCF, but I can say this. I don't think Nvidia should be worth substantially more than the cloud providers that they service.
Mm-hmm. Okay, I mean, Microsoft is about $3 trillion too. So you're saying there's fair value today then? I guess that explains.
I don't think Microsoft's not just a cloud provider. They've got a lot of other stuff going in that business.
Oh, I see. I mean, I don't know. Microsoft, Amazon, they're multi-trillion-dollar companies. So, and then you said they have a business. I agree, but AWS is pretty much, a lot of the Amazon value, I guess, today. And
yeah, I think,
so you believe it's worth somewhere between $1 trillion to $2 trillion then?
I I've not done the math. I just want to make that very, very clear. But gut instinct, maybe around that point. The way I would go about this, if I was going to sit down and do it, I haven't done it yet, is I would try to figure out how many chips are going to be bought every year on a sustained basis after assuming every company has enough chips to build their foundational models, right? Right now, there's like a surge of demand for a year or two, like I said. So now it's like 0 to 1 year left of buying those chips. After they're done buying those chips, it doesn't matter how innovative the next few chips are, unless there's a need for those chips, as people have already seen, and as we talked about in this space, you can swap out A100 for enough A100s for H100. You can swap out enough H800s for an H100. These are pretty interchangeable because you're just looking at a large data center. If you have a large data center, you have a certain amount of teraflops. That's kind of all that matters. What's the difference between waiting 2 months and 2 months and a week to get a new foundational model? It's not groundbreaking for these businesses.
I don't see how Nvidia is worth more than $1 trillion, honestly. I think it's worth a few $100 billion.
How much cash do they have, and how
About
much?
100, I think it's about $100 of cash, 100 billion, or maybe less than 100 billion.
Okay, and how much does the equipment, or like, don't they have their own like factories and equipment, and what's the value of that and the brand? Yeah, there's certain value.
Yeah, a few $100 billion.
The other thing to keep in mind is like DeepSeek in their paper did a lot of work on optimizing InfiniBand and compute and connect. So anybody who wants to follow their path might continue to use NVIDIA. Like I think NVIDIA won the chip makers that are not cloud providers, and they will continue to have value for the next 2 or 3 years until we see Microsoft and Amazon build something like TPUs. When that happens, I agree this could go down.
Well, Amazon
seriously fast.
seems to be doing well with their Trainium, so right?
Yes. Yes, I agree. Yeah.
I don't think Microsoft is there yet, but they're going to get there too eventually.
Yeah, and it takes a few iterations. So like it could be so what I would say is let me put it this way. What is the PE? I'm going to try and do it via PE if we want to do it that way.
I don't know. I think something like 30, 40.
Yeah, that's still very hard because that includes a lot of like one-time purchases, I would argue. So let's say half of their orders are sustained. I'm just making that up. Then it's like 70 years or 70 PE at that point. I don't see how, like, the way I see this is it's a product, not a business. I think in 6 or 7 years, all the money they can make kind of drops substantially almost to zero. So if you're doing the DCF, you can't do infinity. You have to just do like 6 or 7 years and say, how much money will they accrue and how much could they distribute? Certainly, if they only have 100 billion, they're not going to make $3 trillion in the next 6 years. So there's something missing. I don't know, but I'm pretty bearish on it, and I've been pretty bearish on it. I just wish I had followed you and actually taken a short position instead of just covering calls, or sorry, selling call spreads.
I mean, I'm looking to add to it. I just don't see the conditions just yet. I added a little bit yesterday after today's drop.
I've
I took up.
closed. I've closed. I'm neutral, completely on it now.
Okay. Anyway, okay. So that's NVIDIA. We can continue on that later. Any updated thoughts on DeepSeek? Let me see your post here. I have it in front of me. Summary of 5 key thoughts on mania behind DeepSeek. Hope this is easy to follow. The paper never claims to beat GPT-4o. It claims to achieve something similar performance with a more economical training cost. I thought they also have lower inference costs, right, Meta?
What has lower inference cost? H800?
DeepSeek.
No. The inference cost is fixed, right? Like
No,
the
I thought their
cost.
API prices are so much lower than ChatGPT, right?
Oh, in that sense, sure, but you can subsidize anything. Your
Right.
cost is hardware.
Do you
They,
think
they,
they are subsidizing it?
they must be.
Hmm.
You can look at it and say, oh, electricity is cheap, or they're okay with doing it a certain way, or the regulatory framework is such that they get, some compensation. But OpenAI is losing money as well, right? So, I mean, we're comparing who's subsidizing more aggressively.
Okay. So you think DeepSeek inference cost unsubsidized is about the same as ChatGPT?
No, I don't think so because they did use MOE. So for the cloud service, I can see how it would be cheaper than ChatGPT 4o. I agree with that. I
Okay.
think that's because that should be compared to Anthropic and Gemini instead.
I got you. Okay, let's continue. If you can perfectly ablate unnecessary data, you can achieve amazing model compression and reduce training costs.
That sounds like me.
You can achieve amazing model compression and reduce training. If you can perfectly ablate unnecessary data. Okay.
All right. So
No, hold on. We have a lot to go through. Hold on. If I have a question, I'll ask. I think I get it. If all I was focused on was training costs and was using GRPO, I would start by ablating all training examples that do not have the neuron weights during backprop. I would do this in a loop a few times. Excluding this cost is cheating, as I can shift a ton of the training compute to this non-training portion, despite having used GPUs to do this. Similarly, I can avoid having to do the backprop myself and use another model that exists already, GPT-4o or Llama or others, to aid as a teacher model that helps clean up the data set. Again, ignoring this cost means one can dramatically shift the cost from ablation versus training time. To ablation versus training time. I mean, isn't this what Microsoft is claiming to Microsoft OpenAI?
Yes.
Okay.
Yes. This is, and there's also a good piece of evidence I tweeted out recently where this person posted a picture with a bunch of stuff on X, nowhere else. And then they asked DeepSeek about the contents of that picture without sharing the picture, and it answered. Therefore, they must have crawled X.
Right. Right. I mean, is that illegal?
It's, I mean, it's a cross-country thing. It's illegal in the United States and most of the world. I don't know what the laws are in China.
I mean,
but
I think it's so ironic that ChatGPT, Sam Altman is saying, "Oh, you guys use our data." I'm like, "You're using everybody else's data, dude."
No,
You know?
but they are hopefully they'd be legally liable if they aren't following the robot's text, right? So if everybody made their data available for everyone to use, and now they're complaining, "Hey, I gave away all my data, and you did something cool with it. Give me some money." That seems silly. Don't you were giving your data away to begin with, right? Like when Elon bought X, the first thing he did was he stopped giving out the data because he realized how valuable the data was.
Mm-hmm. Right. Right. Exactly. Okay.
Like Wikipedia can't complain because that's their whole business model is that they give away their data.
Mm-hmm. Would you invest in a Reddit IPO?
It would depend on the pricing. I would probably invest in Reddit as a potential acquisition target, depending on the pricing. It's hard for me to answer.
You think it's a valuable data set?
I think it's the most compelling counter data set to X.
Mm-hmm. Who would buy it? Zuckerberg?
Yeah, it could be Zuckerberg, could be Google, could be Microsoft. Although Microsoft has OpenAI already, it would be beneficial to get some kind of real time data, right? Many things appear on Reddit before they appear on X. But Facebook now has threads, so maybe they're getting those. Anybody who just copies things from X and puts it onto threads does them a favor by putting the data there.
Right. Right. Okay. Listen, I need to. Okay, Can you read this to me? Can you read it to us, please? Is that possible?
What is this? My tweet?
Your post, yeah.
Sure.
So just kind of continue from where I left off, please.
Sure. Give me a moment. It's loading.
Yeah, thank you.
So you read on data already, correct?
Mm-hmm.
Okay.
I actually, I didn't read. I didn't read after the second sentence. Comparing apples to apples, basic table stakes. Actually, no, sorry, data. Yeah, exactly. I read the
You
on
finished
data.
it. Yeah,
Right.
you did.
Yeah.
On algorithms, are we including knowledge distillation as an algorithm? It seems this way to me, based on the text. If so, any media comparing the distilled model to large cloud models should be ignored as they don't have any experts or nor exercise proper editorial oversight. Comparing apples to apples is basic table stakes. You can't take the performance of the larger models and assume the cost for compression can be ignored. A model with tons of training data ablation may not distill as efficiently as one that skips it and knows they will be distilling it later. The distilled model is the only thing that was released with open weights, whatever the value of that is. I personally hate the misuse of open source and don't think open weights is a significant thing. Modifiability and reproducibility are needed to be open anything in my book. AKA can be used with a generous license. Oh, this is horrible English. I should have written this better. That last sentence, I'm just going to ignore that because I
You
didn't write
could
that well.
use LLM to improve it after you write it.
I certainly should. I wrote it inside the app itself, and I should copy it. That was some feedback I received from people. I will begin using a editor rather
I mean,
than
I understand it,
typing. Yeah.
but I think that's probably because we talk about these things all the time.
Yeah, I agree. The other thing is like ablate for the people listening
Right,
means
exactly.
delete, and I didn't really
Exactly.
explain that. And
Exactly.
GRPO is a new training technique. The specifics of that are complicated to go over, but I should have probably just at least explained that. So what I'm saying here on algorithms is knowledge distillation, you could argue is either a process or an algorithm, but it's not training, right? This is how you compress the large model down to a small model. And obviously that costs a lot of money. So the thing that they released to everybody that people are playing with, they just ignored that entire cost. And so it's very strange that all these financial experts are looking at like $80 billion of investment dollars over an entire year to build out a data center, do R&D, do training, do inference, do compression. And they're just saying all those 5 things, we're just going to compare it to this one section of training, not even including ablating, not including testing, just training. It's nonsense. It's like comparing the cost of making a Tesla to the cost of making a Toyota
Right.
Camry's tire.
I mean,
It's like,
I
what are we
agree.
doing?
I agree with you, but on the other hand, I don't think that's really the driver of the 20% drop in Nvidia's market cap. I think it's really important to separate what the talking heads are saying and what the real risk to Nvidia here is.
Do you think that what happened here is a lot more of the investment community started becoming wise to the fact that they should learn what it is, and as they started to learn it, they realized, oh crap, our valuation was too high?
I don't know. I don't know if that's what happened. It's hard to say, but I think like it's impossible to say why it dropped. And
That's fair.
that's one thing I really like about the stock market is that there is no controlled study here. Even after the fact, you don't know. Even if all the headlines say one thing, you just don't know. You will never know. And
Let
being
me see.
comfortable with that is really important, I think.
Let me see if I can make the argument for why it would make sense. If there were a lot of investors who thought, and I think I have seen this a lot, that you need H100s, you need those chips, and they're the only chips you can use. Mixture of experts becoming a viable, proven approach, and the fact that they did it with 8-bit, which brings in tons of other manufacturers as potential chips you could use. Those two things combined make it clear that we're not in a supercomputer race, we're in a data center race. And NVIDIA has made their expertise the construction of supercomputers, right? They make these really large, super powerful chips, and they sell those one chips. And everybody else is focused on, hey, can we get a lot of weak chips together, string them together in a distributed way, and then have them act collectively as a supercomputer? And that didn't used to be possible with AI until mixture of experts, both
I
on
see.
training and serving.
I see. So you're saying without a mixture of experts, DeepSeek, no way would be able to do what they did.
Correct. And mixture of experts was, talked about almost 2 years ago when Google first came out with their models, and in the papers from 2018.
Right. Right. Yeah, you did talk about it here before, but I don't think you said anything around mixture of experts is going to make NVIDIA's H100s or I guess Blackwell chips less valuable?
I think I tried to talk about that stuff, but sometimes these things are hard to spell out
Mhm.
eloquently.
Now, here is an argument that the co-founder of LinkedIn made today on CNBC.
Actually, sorry, before you go to that,
Mhm.
if you go back and you listen to when I used to be really big, and I still am a big fan of Mojo, and I was talking about
Mhm.
Chris Latner's outlook
Mhm.
and talked about mixture of experts, that would have been around the time I would have talked about it if I
I see.
connected the dots properly.
I see. Okay. Okay. I mean, like part of the problem is that I'm not close to your level of knowledge about these things, so I can't really ask the right question that would bring that out.
That's fair.
But because of our conversations, when DeepSeek came out, I knew this was a breaking point for NVIDIA, and I posted it, and that's because of our conversations. But I need to be able
Yeah,
to, like,
that's good.
I would like to get to a point where, like, to see mixture of experts allowing these. So that's one level deeper of understanding I need to get to.
Let's try that with Titans.
Exactly. Exactly. Exactly right. All right. So we have. Do you want to do architectures next? Now,
Sure.
before we move on, is there any model that's open source and not just open weighted?
Mistral.
Mistral. But it's not good enough to matter. Is that it?
Correct. It's not that it's not good enough to matter. The reason why it doesn't matter is, let's say Tesla came out and told you exactly how to make a car, all the parts, all the materials you need to make a car, and they just open sourced the manufacturing process for making cars. That doesn't mean somebody in the garage is going to start making cars. All that does is it makes the other car manufacturers that have factories and have all this supply chain and have all this money be able to compete with Tesla better. That's what's
Mhm.
happening, right? So you can open source the model, great, but do you have 10,000 GPUs to do this?
Mhm.
If you don't, then you can't. And the DeepSeek paper just is like, well, let's assume you can just rent them, and then when you're done renting them, you can stop renting them. It's not how it works, right? You can't just go to somebody and say, I want you to buy 10,000 chips. I'm going to rent them for you for 2 months. After that, no one is going to rent them from you. You take the loss. I'll just take the one-time rental. That doesn't make any sense.
Mhm.
Oh, and also, I want you to rent it to me at such a cheap price. Like it's not like they're making their money back in those 2 months.
But I guess, like, I mean, why are you so focused on whether it's open weights or open sourced? Why is that important to you?
It's because everybody's trying to create a label as if this model is really good because it's open source, right? So they make it sound like
Yeah, I don't
this.
understand that part. I don't get that part at all.
Yeah, so
You know?
if you think of Linux, right? When Linux came out, it was open source and it
Right.
kind of destroyed Windows server offering, and they got removed from all the data centers and everybody just used Linux because while Linux is not as user friendly, it is more so now, but at the time it definitely wasn't user friendly, and Mac and Windows were, because they had these graphical user interfaces. It was much more efficient, and the data centers are not managed by an end user; they're managed by businesses that have like technically aware users. So those technically aware users are like, I'll use the thing that's cheapest, and free is hard to beat, right?
Mhm.
So when you start saying that these open source models are out there, that starts a lot of people saying like, oh, Hugging Face is going to host this, and Microsoft and Google and all these other places are going to host this free model, so I could just use the free model instead of paying for the proprietary model, which makes sense. So that makes it sound like your API costs will come down a lot. But that, to me, where the thing gets lost is what percentage of your inference cost is because of the R&D on the proprietary model, and what percentage of your inference cost is on just running any model.
Mhm.
If the costs today are reflective of just renting the expensive chips and running the expensive chips, let's say 80 or 90% of that cost is just that today, then the discount of switching from proprietary to free is at most 10 to 20%.
Mhm. I got you. Okay.
And the markets
All
are
right, and
making it
then
sound like it's 100.
okay, gotcha. We can definitely continue. I mean, it's just time pressed today for the earnings and everything. We have 10 minutes. Um, can we skip to number 4 on the $2 an hour H800 rental assumption? First, notice that they don't say they did this; they assume it. The cheapest cloud price I can find is Amazon EC2 P5, which works out to about $5 to $6 an hour H100s. I don't know. I've seen cheaper ones. I think it's $2 to $3 from what I can find.
Yeah, so I'm going to be posting a correction to this because it was pointed out to me. But the $2 to $3 ones you see are spot pricing for a very small number of chips. So what happens is if you want to get a lot of chips co-located, that's more expensive than if you want to get a few chips here and there.
Oh, I see. I see. I would have thought that would be cheaper because you kind of, especially if you sign a 12-month contract or whatever, you would get like a bulk. I think you would get a bulk discount if you sign longer term contracts, right?
It's possible if you sign a very long-term contract, but then you can't assume $2 per hour for 2 months.
Mm-hmm. 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 Yeah. Um, yeah, man, these H100s, they were selling, if I remember correctly, up to like $70,000. Is that not correct?
In the resale, I think they're originally 40K.
Yeah, in the resale market, exactly. Where do I go to get those? Is that on eBay?
Yeah, that's on eBay and other places like that. Be careful what you buy, though. You might not get an H100.
Yeah. And there's a lot of trims of it too. Like it's not just one H100. There's a lot of different
Correct.
H100s.
Correct.
Depending on memory configuration, how much memory it has, which seems to be kind of the primary driver of value. Is that correct?
It was, yes. So if you look at things like the Titan paper and you look at things like MOE, the memory consumption dramatically falls.
Mm-hmm. Mm-hmm. Exactly.
And
Very
this is something
Very
I've been talking
interesting.
about in your spaces from a compression perspective for a while.
Okay. So let's say because of MOE, so Titans comes after MOE. Is that correct?
Yeah, Titans just came out like a month ago. It came out December 31st. Remember, you were talking about DeepSeek, and I was like, hey, check out this other paper.
Right. Okay. So, very interesting. So, is it that MOE drops the memory need, and then Titan drops it another step down?
The best way to think about MOE is in traditional servers, right? So they used to be called server farms. That was like, think of a condo with a whole bunch of apartments that you can rent, and they're all independent. Different people live in each of the condos. And then data centers came along, and instead of having all these different rooms in the condo, it became one giant mansion, and everybody knew each other, and they're all living, and it's fun, and everybody's just in the same mansion, right? It's one giant party. They're two totally different things. From the outside, it's still the same building, the same number of rooms, if you will, but it's two completely different configurations. The thing with the individual rooms is you can only, let's say you want to throw a dinner party, you can only throw a dinner party as big as you can fit in that one room. When you have this giant mansion, you can throw a dinner party as big as you can fit in that giant space you've now created by combining all these things together. So that's where we went from like server farms to data centers, right? So all these machines started talking to each other through distributed compute. We were in that software. So that was software 1.0's development. Software 2.0 was stuck in this place where you had to run everything on one chip, right? And then it was like breaking when they're like, oh, we got 8 chips to talk to each other or 4 chips to talk to each other. And then you see the TPU papers come out and they're like, we got 16 chips to talk to each other. 4 by 4 by 4. I'm not doing my math right. 4 times 4 times 4. That's how many they got to talk to each other. Dojo was like, we're going to get 25 to talk to each other, 5 by 5. And then you start seeing papers come out and they're like, we got 1,000 by 1,000 to talk to each other. There's like a whole data center now with TPU6. And they're like, we try to connect as many as we could, and we're not seeing a drop off. There's no limit on this. That changes the dynamic to, okay, well, now I don't really care how big the rooms are. As long as I have tons of rooms, I can still get the volume I need, and then I can still do what I need to do. And now you're serving. So it really reduces things down, because in the old way, if I had a model and had 2 things, it did creative and math. And there was twice as much demand for math as there was for creative. I had to bring up 3 instances of the brain, and 2 of them would serve math and 2 of them would serve, one of them would serve creative, but the one serving creative would just have memory wasted for the math neurons, and the one serving math would have memory wasted for the creative neurons. With the mixture of experts approach, you have a small router, and then you have one creative that's very small, one math that's very small, and another math that's very small. So now you're using smaller chips. Or alternatively, you put even a larger math model and an even larger creative model in the same chips. But instead of having 3, you can just have one creative and two math, and you can perfectly load balance. So as
Okay.
demand shifts, you can shift it.
Okay. And Titan, I guess let's talk about that next space. Okay, I want to learn. I need to read the paper first, and then we can talk about Titan and the implications for NVIDIA, implications for Tesla, FSD, Optimus, etc.
Yeah, I think that'll be more on the
now,
cloud side. Yeah.
do you think? Oh, I see. Okay. So, do you think that influenced the design of Dojo then?
Dojo was designed before the Titan paper.
Yeah.
well
So,
before, yeah.
what's going to happen now? Dojo program, is it gone?
I told you, right, a long time ago. Dojo's only
Yeah.
purpose is negotiation with
So, what about
NVIDIA.
Blackwell? What about Blackwell? Does that screw up Blackwell?
It does, in my opinion. Blackwell
Oh,
was
wow.
designed to solve the wrong problem.
What problem?
I think Blackwell was designed to solve the wrong problem.
Memory?
Correct.
Yeah, exactly. Because it has like twice the memory, I think, of the Hopper platform.
Blackwell is like when everybody was
Now,
making
okay, so
computers.
let me ask you. So I would love to dig deep. It's just not today, right now. But
Sure.
so just one quick question: if you were designing a server side chip today, training chip today, if not memory, what would you maximize?
This is harder to answer. So let's talk about this another time.
Okay.
I
But
just need to
pick
be
one,
careful about.
just
I
a
need to
teaser. Oh, I see.
I need to be
Okay,
careful about
okay.
how I answer that question.
Okay, got you. Okay. All right, cool. All right. Oh, man, what a day.
Actually, here. Okay, if I was going
Yeah.
to pick one, it'd be interconnect. That would be
Okay.
it.
Okay. Interesting. Maybe that's why. So we're talking InfiniBand, right?
InfiniBand is one. Yeah, basically
Exactly.
the
Because that's
corridors
why
between the
I
rooms.
guess that's why Jensen started talking more about InfiniBand on these calls.
Oh, I didn't see that. Well,
Yeah.
recently, yeah, that makes sense. Yeah, it's very, very important for inference.
Uh-huh. And they started talking about more networking, even though it's like a fraction of the data center revenue.
Yeah,
Wow.
networking is key. Yeah.
All right. Interesting. So it's more about teamwork then.
Correct.
It's not just about one GP, it's about teamwork.
Yeah, it's like you want to hire the smartest person to build like your company and be the only engineer at your company, or do you want to hire like 10 not so smart engineers for the same salary and they all work together as a team?
Which company is the best at networking today? Is it there's some companies that are focused on providing networking technology, I think, right?
Networking is different. Networking isn't what we're talking about here. We're talking about chip to chip, not chip through router to chip.
Oh, I see.
Yeah,
I see.
the
Okay,
way you're
never
talking
mind.
about is networking would be the latter. Yeah.
Right. Yeah, exactly. Okay.
And the chip to chip stuff is extremely proprietary. Like there's not even papers about that stuff. So
Really?
good luck. Good luck
There's-
analyzing that.
There's no open source there, huh? I can't just ask ChatGPT.
Maybe Grok Q was open source. I don't think so. But take a look at what Grok Q did, which was created by a bunch of former Google employees who worked for DeepMind. And you can kind of see where that trend is going. And when they first came out, they had almost no memory on their chip. People thought it was a stupid design, and now they look like geniuses because all they did was focus on interconnect.
So you think Grok Q is going to be able to raise more money and going to be a major player in the future?
I have no idea. It's a great design, at least to my I'm close to that, but that's not my space.
Okay. So Grok Q is a big threat against NVIDIA then. Is that fair?
No, I'm not going to say that.
You're not gonna say it. Okay.
No,
Okay.
no, I'm not going to say that.
Because it's just a few guys so far, right? With a
Yeah,
lot
you need
some
billions
money.
of dollars. You need fabrication. You need to be able to place an order. It's a
But the
big chicken and egg
fabrication is
problem.
on the TSMC side, so they
Yeah,
don't need to fabricate their own.
Yeah, but you got to pay for the initial fab. You got to have like a massive order before TSMC takes your contract.
Yeah. All right. Markets closed. Tesla closed down 2.5%, which is really interesting that the stock is selling off. In the last 5 days, the stock is down 7%. In the last 4 days, the stock is down 7%, which is kind of unusual going to earnings release. We're going to get to earnings in about 5 minutes. Go ahead.
Isn't that just like an index effect? People are selling things off in general?
I don't think in the last 7%. Let's see, S&P 500 in the last 4 days we're looking at 1%. 7% is all excessive. Let's look at NASDAQ in the last 5 days, 2.3%. Yeah, 7% is a couple percent more than it would be normally. But especially going into earnings, it's a little unusual. Anyway, I don't know if it means anything. Who knows, right? But it could. I mean, Troy has been pretty negative about this Q4 earnings, and he's widely followed. So that could be part of it. All right, so we're gonna get some news. Go
Just
ahead.
for your reference, because we've talked about this a lot today, I did sell some Tesla.
Oh, really?
At a with covered calls, so not like just I'm in a different place in life, so I'm actually trying to make some cash available for buying a home. So there's a bit of that driving.
Sure. Okay. Now, when this comes out, you cannot talk. Okay. If you're gonna talk, if you can't help yourself, move yourself to listener. On the earnings, what I do is just pull up the PDF and I read. I read the entire thing cover to cover without any interruptions, and then we look at stock price. Then we kind of wait a little bit for the earnings call. I don't expect to see anything that is like the goal of Tesla Live. One of the goals is that we kind of educate ourselves to the extent that we don't get surprised on these earnings calls and everything. So, and that's been the case for the last couple of earnings. So let's see if that's the case today. We're still waiting. No change so far. Usually takes a few minutes. Can I ask you a quick question? Oh, no, never mind. He's not listening now. The other thing I want to talk about is quantum stocks. At some point, I want to talk about quantum stocks. Oh. No news, as far as I can tell. The stock was gyrating between 385 and 390 today in the afternoon session, up and down, up and down. I still don't see. There we go. Oh, there's a drop, I think, after market. So let's see if it's announced already. The stock might be down slightly after hours. Yeah, it looks like it hasn't been announced just yet, but it dropped 3% after hours, it looks like. That's weird. Okay, earnings out, 73 cents. Adjusted EPS estimated 75, so lower than expected. Revenue is lower than expected materially. That's due to the 0% discount. The stock is down now, lower a few percent. Let's see what else we got. Gross margin 16.3. Wow. Operating margin 6.2. Yeah, these are bad numbers. Free cash flow $2 billion. So I'm guessing CapEx was lower than expected here. Free cash flow $2 billion. EBITDA 4.9. Okay. I mean, this is it's bad numbers. We were expecting. That's why I had a short position in Tesla, but this is in line with expected. In line with expected, as far as I'm concerned. But the market is not going to like these numbers. There's an EPS miss. There's a top line miss, bottom line miss. So let's look at deeper now in Tesla Investor Relations Q4 numbers. Let's download the shareholder deck. Here we go. You know what? I'm gonna show this on YouTube. So I recommend watching on YouTube. Let's watch it together. Can I do that? Oh no, I can't do that. I can't do that. That's okay. I'll just read it here. That's fine. That's okay. All right. $7.1 billion GAAP operating income in 2024, 1.6 billion in Q4. Okay. 7.1 billion GAAP net income in 2024, 2.3 billion in Q4, including 0.6 billion mark-to-market gain on digital assets. So they sold some Bitcoin. No, mark-to-market. I guess that's the that might be accounting rule change. I don't know if they sold it. Doesn't matter really. $8.4 billion non-GAAP net income excludes stock-based compensation and the tax, etc. 2.6 billion in Q4. Okay. Operating cash flow of 14.9 billion in 2024, 4.8 billion in Q4. Free cash flow of 3.6 billion. I mean, this is really the figure that I've been kind of banging the table on. Free cash flow that tells us running about 1 billion per quarter, and this is in line with that. And that a company that's generating $3.6 billion annual free cash flow should not be worth over a few $100 billion. So the rest of it is just speculation on robotaxis and Optimus that is really not even around the corner as far as I'm concerned. So Tesla stock is plunging after hours, and then we're going to continue. So this is very much in line as I expected, and it is what it is. Increased AI training compute by over 400% in 2024. Over 3 billion miles cumulatively on FSD supervised as of January. Over $3 billion on FSD supervised. Completed construction of Mega Factory Shanghai. Summary. Q4 was a record quarter for both vehicle deliveries and energy storage deployments. We expect Model Y to once again be best-selling vehicle of any kind globally for the full year 2024, and we have made it even better with the new Model Y now launched in all markets. In 2024, we have made significant investments in infrastructure that will spur the next wave of growth. This is all just fluff, including vehicle manufacturing capabilities for new models, AI training, compute, and energy storage manufacturing capacity, all fluff. Affordability remains top of mind for customers, and we continue to review every aspect of our cost of goods sold per vehicle. Number 5 footnotes. Calculated by dividing blah, blah, blah. Okay. To help alleviate this concern, in Q4, COGS per vehicle reached its lowest level ever, less than $35,000, driven largely by raw material cost improvement. Okay, this is exactly what we predicted, helping us to partially offset our investment in compelling financing and lease options. The energy business achieved another record in Q4 with its highest ever gross profit generation. Construction of Mega Factory Shanghai was completed in December and will begin ramping this quarter. Powerwall deployments. Achieved another record quarter as we continue to ramp Powerwall 3 production and launch in additional markets. Okay. This is exactly what we predicted. Free cash flow is about $4 billion annualized. Energy business is growing profitably, which is what we thought. I think energy is going to suffer from total addressable market and competition. COGS per vehicle, I said that it would continue to drop, and that's exactly what happened. Let's continue. 2025 will be a seminal year in Tesla's history as FSD supervised continues to rapidly improve with the aim of ultimately exceeding. This is also fluff. This will eventually unlock an fluff. Everywhere is fluff. It's like 3 lines here that's actually of anything meaningful. Okay. Let's continue. Let's bring in Meta if he's available. And man, this company can be so great, but it's just automotive revenues down 8%. Energy generation and storage up 113% year over year. Service and other revenue up 31%. Okay, total revenues 2%. So no growth for 3 quarters in a row. Q2, Q3, Q4. Actually, Q4 2023 was 25 billion. So it's been about 25 billion every quarter, except for Q1. There was a big drawdown there. Total gross profit is about the same, $4 billion every quarter for the last 5 quarters. Operating expenses, operating expenses came a little higher than expected here, 2.6 billion. Income from operations, 1.6 billion. Operating margin, 6%. Okay. I'm on page 4 of the PDF, for those of you who are kind of following. Adjusted EBITDA, 4.9 billion. That's not bad. Adjusted EBITDA is not bad, I guess. So we'll take a look at that a little bit. Up 25% year over year. Up slightly, about 6-7% from the last quarter. So I'll take a look at that, what that is about. But in a high capex scenario, EBITDA is not the right figure. And when they base Elon's comp on adjusted EBITDA, that was a big red. That should have been a big red flag for me. But net income attributable to common stockholders. Okay. EPS. Okay. Free cash flow 2.0 billion, down from 2.7 billion last quarter. In line with last year's same quarter at 2.0, 2.1 billion. Cash and cash equivalents, 36.5 billion. So I wonder if they sold. Yeah. All right. Total automotive revenues, 2024. Okay, I'm going to skip the annual, page 5. Man, look at this. Free cash flow in 2024, $3.6 billion, down from $4.4 billion last year and $7.6 billion the year before. That is trending in the wrong direction. That's trending in the wrong direction here. Okay. CapEx $11 billion in 2024. So that's multiple $1 billion of H100s, basically. Let's bring in Mike and let's bring in Meta if they're available. And let's continue. $36.6 billion of cash and cash equivalents, which is impressive, but it doesn't mean much for the business. Total revenue increased 2% year over year. Plus, on the plus side, growth in energy generation and storage and service and other, growth in vehicle deliveries, and higher regulatory credit revenue. Okay, did they not separate that out this time? Yeah, I don't see that separated out. Wow, they took that out. Interesting. On the negative side, reduced sexy vehicle average selling price due to pricing, attractive financing options, and mix. Okay. Profitability, reduced sexy vehicle ASP, negative side, increase on operating expenses. That's exactly what I said. The operating expense jumped a little bit here. Driven by AI, other R&D projects. Okay. Plus side, growth in generation and storage business, gross profit. Okay. Lower cost per vehicle, which is exactly what we predicted. Higher regulatory credit revenue. Okay. Cash, 36.6. Operational summary. Yeah, this is really bad. And let's see. Tesla stock is down 4% to $374. And I think this might just be the beginning, unless if they turn it around on the call, which I don't expect. Okay. Mobile service fleet, flat charger stations connectors up about 17-19%. Global vehicle inventory days of supply 12 days. I mean, that's one of the lowest ever. So there's a bit of inventory. Inventory is a little low, which means they must have had. I mean, I'll confirm that in a second. But which means they must have had a benefit from working capital here. So despite that, their free cash flow is so low. Total production 1.77 billion. They're restricting supply. Deliveries are down year over year 1.789. Short of the goal and year over year decline. Okay. Storage deployed 31.4 gigawatt hours, up from 15. So that's 100%, 110% increase year over year. Okay. Tesla locations 1.359. Mobile service fleets 1895. Okay. Fine. All right. Vehicle capacity, page 9. Preparations are underway across our existing factories for the launch of new products in 2025, including more affordable models. New Model Y has launched on the configurator globally with the production ramp and deliveries beginning later in Q1. All right, US, California, Nevada, Texas. Semi-factory construction continued in Q4. Recently completed roof and wall enclosure of the main building area. First track builds are scheduled to start by end of 2025, with ramp beginning early 2026. Preparations are underway for Cybercab lines at Gigafactory, Texas, with volume production planned for 2026. Zero chance. Okay. Given its unique functionality, including power share, stainless steel exterior, enhanced durability, and bioweapon defense mode, we deployed a fleet of Cybertrucks equipped with Starlink in Los Angeles area to help first responders and those impacted by the fires get access to electricity and Wi-Fi. We expect Cybertruck to be eligible for the IRA consumer tax credit, helping to improve affordability access for even more customers. Okay, I thought that was the case already. Okay. APAC Shanghai in Q4, we achieved record deliveries in China as Model Y becomes the best-selling vehicle for the full year. Tesla also became the fastest-growing brand in South Korea, and we launched vehicle sales in Philippines. Okay. Europe in 2024, Model Y is the best-selling vehicle of any type in Denmark, blah, blah, blah. We expect Model Y to have been the second best-selling vehicle of any type in Europe. Tesla was the most sold brand in Norway for the 4th year in a row. With Model Y, Model 3. Okay. AI. FSD miles V12 and beyond has increased, but it's not increasing exponentially as we predicted. The straight line is now coming up to about 3 billion miles. Cumulative miles driven. Tesla vehicles using autopilot technology, the safety, cumulative miles, millions of miles driven before an accident, improving on a steady line basis. Tesla vehicles not using autopilot technology has declined in safety. That's interesting. I wonder why. And US average is increasing. Let's see. AI software and hardware. In Q4, we completed deployment of Cortex, a 50,000 H100 training cluster at Gigafactory, Texas. Cortex helped enable V13 of FSD supervised, which boasts major improvements in safety and comfort thanks to 4.2x increase in data, higher resolution video inputs, 2x reduction in photon to control latency and redesign control, among other enhancements. FSD supervised can now start from park and from on-park, reverse and park capabilities, everything we knew already. In Q4, Tesla vehicles using autopilot technology drove 5.94 million miles between accidents. The best Q4 ever. Okay. Compared to US average of 0.7 million miles. Progress on Optimus hardware and software continued in Q4, including the latest generation and robust locomotion and training on additional tasks ahead of planned pilot production in 2025. Okay. So pilot production in 2025, nothing about volume production or anything. And Cybercab is supposed to be volume in 2026, but I doubt that's going to be the case. All right, let's continue. Vehicle and other software. Holiday release include Apple Watch Sport. Customers can pair watch as a key to unlock and lock their vehicle without ever pressing button, just like the phone key. With a premium connectivity subscription, dash cam, sensor mode, clubs can be viewed and downloaded directly from the Tesla mobile app. Okay. Battery powertrain and manufacturing. We process our first spodumene lithium containing concentrate through the front end of the lithium refinery only 18 months after groundbreaking, much faster than any plant we know outside of Asia. The intermediate material was on spec, and we are on track to commission the plant in 2025. Our in-house 4680 hit a production rate exceeding 2,500 Cybertrucks per week. Okay. Energy business continue to grow rapidly in 2024 as we expand capacity for both Megapack and Powerwall to meet demand. Give me 1 second. The stock is down around 4%. I'm trying to see if it bounces a little bit. Okay. We're gonna look at the financials in a little bit here. Energy service and other gross profit has been flat for 3 quarters. This includes Megapacks and Powerwalls. On page 11, there's a right-hand graph, upper right, and then energy storage deployments are about the same for 3 quarters. So it's very volatile, obviously. Changes quite a bit. Okay. Let's see. I think there are other companies announced earnings too. So let me see here. Microsoft announced it was down about 4% at the beginning, and then recovered, and then it came back down again to 2% down. So that's in line with Tesla. All right, let's see if there are any other companies here that are announcing. '29 after Microsoft Meta announced also. Let's see. Meta. Meta is about the same so far. So Microsoft, Meta, Tesla, and then IBM announced. IBM is up 8%. And then ServiceNow announced down 10%. Wow. ServiceNow down 10%. Interesting. Trying to see if I want to add to my short here. The stock is down only to 4%, but I think it should be down much lower. It's now down 2%. So maybe I'll add a little bit. Let's continue to read. I'm going to skip the services side. The energy business achieved the record deployments for both Powerwall Megapack and the combined 11 gigawatt hours, resulting in a record progress profit in Q4. Material and other costs continue to come down in Q4 at Lathrop Megafactory. Both Powerwall and Megapack continue to be supply constrained as we open new markets. Okay. Shanghai Megafactory will begin to ramp in Q1. Okay. All right, Tesla stock is flat now, so I'm going to add to my short a little bit here. Hey, Meta. How are you?
Good.
I just added to my short a little bit.
Is it because you feel like the manufacturing prowess isn't where it needs to be, or some other reason?
The stock should be down 50% on this fucking stupid numbers. But they generated $4 billion of free cash flow, and this includes energy. And this we're seeing the max profitability at this point of Lathrop factory. and I would have expected much better results on this. But you know, what are your key takeaways here?
I haven't had enough time to dig in.
Okay, Mike, what's your key takeaway here?
I agree with you, Yaman. Fourth quarter earnings performance is not very good. Certainly doesn't justify the run up, especially post election. But it all comes down to FSD. So short term, long term.
Mm-hmm. Yeah. I mean, all they said on FSD is that they expect volume production of cybercabs in 2026. I just don't see how that's possible. I don't know if they're even close. But yeah, it is what it is. Man, stock is so volatile after hours. It's crazy. I mean, I was hoping for a bounce so I can add some more. It was down like 4%. And then it kind of became even. So I added a little bit. And now it's up 2.6%. So let's continue here. Meta, anything else on your end? Anything on the
Question.
AI part?
Yeah, that's what I was going to ask. Let's say they brought up a whole bunch of machines in the last quarter. How would that be reflected on the balance sheet here, or on the earnings here?
It wouldn't be on the earnings. It would be on the balance sheet.
Okay, so that's not affecting even the free cash flow?
Yeah, free cash flow, yes. It would be in the free cash flow. But you said earnings. So earnings means net income statement.
Yes, sorry, correct. I meant like in this deck. I should have said it differently.
Gotcha. Yeah. It would be in CapEx. Let's continue. Oh, look at that. We have a new slide on page 15. Cybertruck, advancement in vehicle technology and architecture. They spelled it out. Okay. New Model Y, some pictures, new Model Y, new Model Y. Some marketing materials here. Cortex 50,000 GPU training cluster. Okay, great. E-metrics quarterly. Okay. Let me see. Did they say anything about Outlook? With advancements in vehicle autonomy introduction of new products, we expect the vehicle business to return to growth in 2025. The rate of growth will depend on a variety of factors, including the rate of acceleration of our autonomy efforts. Production. We expect energy storage deployments to grow at least 50% year-over-year in 2025. Okay, so they didn't say the 20-30% growth that Elon talked about in the last earnings call. They didn't put that in writing here for vehicles, because I don't think that's possible either. So. Cash, we have sufficient liquidity. Profit, while we continue to execute on innovations to reduce the cost of manufacturing operations over time, we expect our hardware-related profits to be accompanied by an acceleration of AI, software, and fleet-based. That's been the same. Plans for new vehicles, including more affordable models, remain on track for start of production in the first half of 2025. These vehicles will utilize aspects of the next generation platform, as well as aspects of our current platforms that will be produced on the same manufacturing lines as our current vehicle lineup. Plans for new vehicles, including more affordable models, remain on track for start production in the first half of 2025. Okay, I mean that's going to be the Cybertruck with the steering wheel. So I mean the Cybercab with the steering wheel, basically. So the cheaper model, I'm guessing, because we've seen some pictures of that. Purpose-built robotaxi product, Cybercab will continue to pursue a revolutionary unbox manufacturing strategy and is scaled for volume production starting in 2026. What do you think about that? There you go. You got your unbox manufacturing strategy, Meta.
Yeah. I want to see it rather than talk about it.
Yeah. Okay. This approach will result in achieving less cost reduction than previously expected, but enables us to prudently grow our vehicle volumes in a more capex efficient manner during uncertain times. This should help us fully utilize our current expected maximum capacity of close to 3 million vehicles, enabling more than 60% growth over 2024 production before investing in new manufacturing lines.
That's pretty promising. I think Unbox was also theoretically going to allow them to do more models on the same line. It doesn't seem like that's the direction yet.
Mm-hmm. Okay. Lithium factory starting to come online.
Do you want to talk about page 10 in more detail, or do you want to do that at the end?
What's page 10? Let's see.
The AI page.
I mean, there's nothing here that I wasn't expecting. The FSD miles continue to increase at a steady rate. I mean, actually, you can see the kind of slope dropping a little bit. So that's also in line. There's no increase in FSD take rate so far with FSD supervised or V13 or V12.456, etc.
There's data here. I think this is new. The graph on the bottom right,
Mhm.
the million miles driven before an accident occurs, broken down by autopilot versus not autopilot.
Mhm.
Have they shown it this granular in a chart before? Of like, they're
We've
basically claiming
seen it
2x safer now.
2x safer how?
Sorry, 2x safer than when the graph begins, which is they're at 6 versus 3 since Q4 2019.
Mm-hmm.
But this is by
Yeah.
year. It's not by quarter.
Yeah.
For a second, I thought it was by
Let me ask you
quarter.
something. Why do you think Tesla vehicles not using autopilot technology dropped from 1.6 million
Because
to
as
1 million?
yeah, I think as the vehicles not using autopilot, some of that is shifting into vehicles using autopilot. And
Exactly.
bad drivers continue to remain.
Exactly. That's exactly right. There's some sort of reclassification going on here, which is really sad to see.
Is it reclassification or is it take rate with like free trials and stuff like that?
No, I think they're reclassifying passive safety stuff.
I would expect to see a similar jump on the other end then.
Where?
On the accident from FSD side.
Mhm.
Like the red line and the blue line didn't have like a mirror, right? So, but again, there's a weight difference.
Mhm.
But like the number of contributors to the red line should be much less than the number of contributors to the blue line, right? Because there's far more cars without FSD or autopilot.
Can I just read you something?
Sure.
Defendants next argue that several timeline and safety statements 7, 9 to 11, 13, 16, 18, and 26 are non-actionable statements of corporate puffery and optimism. In the Ninth Circuit, vague generalized assertions or corporate optimism or statements of mere puffing are not actionable material misrepresentations under federal securities laws because no reasonable investor will rely on such statements.
I'm an unreasonable investor.
Yeah. Yeah. So I don't care what this graph shows, frankly. Let's look at financial statements since these are audited. Operating cash flow, 12-month operating cash flow, flat for the last 3 years. What do you think about that?
I mean, they've grown without increasing their costs. Is that a good thing?
No.
You want to
They
see the
grow-
cost grow, or
they-
you want to see the cost come down?
I want to see revenues grow faster than costs. Neither has happened.
Do you not agree that it's been an extremely tough market for cars?
Yeah.
So growing in a down market versus staying flat in a down market, isn't that relative growth? In theory, if the markets eventually get good again for car buying, wouldn't that mean that they would go up higher?
Mhm.
when I see these things, it's really hard for me to extract macro versus micro. I think it's too short term to be able to pull out macro
Well, it's 3
effects.
years, you know.
Yeah, but the macro effects have been affecting for 3 years, right?
Well, you know, I don't know. Are you projecting lower interest rates and 0% interest rates? So Tesla will be back to being great because of Powell?
No, I'm not projecting there'll be 0% interest rates. I'm just saying, like, if at some point interest rates do get cut, then yes, Tesla would be better because of Powell. I think Tesla at present and a lot of things in the market are uh, currently being priced as if there will be a day when interest rates come back down. If we find that interest rates don't come down, at some point there'll be capitulation and a lot of things will collapse.
Um, did they sell Bitcoin? Let's see. That would be in cash flow. And it's so crazy. So crazy. Proceeds from sales of investments. No, I think this is probably a mark to market. They didn't sell Bitcoin.
What do you make of the average COGS going down still?
We
It's
talked
just
about
prices
that.
are coming down faster, right?
That's exactly what we predicted, and that's exactly what happened.
Do you think COGS continues to go down?
Not in the near term, I don't think. Okay. Let's see. Mike, anything else on your end? Noticing anything?
Not really, just an expectation of 50% increase in energy deliveries in 2025, and that's lapping an over 100% increase in 2024. So that's right on target. They're supply limited in energy, meaning there's more demand than their capacity, even with Megapack factory build out in Shanghai. So energy is still supply limited.
How do you feel about the spodumene stuff? That's kind of promising, right? Like, if they're currently constrained by the amount of cells they have, which I think is still the case, that could theoretically explain the cost, right? Because supply and demand, there's still too much price on one of their core materials for building these things.
I don't think there's a battery shortage right now. Do you think there's a battery shortage? Do you think EV Tesla sales are limited by batteries?
I think high quality, high grade batteries, yes.
Yeah, I don't think so.
I think if there was an oversupply of batteries, the COGS would be coming down even faster.
Okay. All right. Let's see. Let's go to balance sheet. Accounts receivable down $2.5 billion. That's interesting. Accounts payable about the same. So they have a massive tailwind here from working capital. That's really interesting.
Can you explain that? Is that because of the reduction in vehicles
Yeah,
that they hold?
they accelerated collecting AR, basically accounts receivable. They collected from what people owe to them, $2.5 billion. And you see this in changes in operating assets and liabilities plus $1 billion. So without that, the operating cash flow would be even lower by $1 billion, basically. And capital expenditures came down from 3.5 last quarter to 2.78. Yeah, I mean, look at this in the last 2 quarters, they have a tailwind of $2.6 billion from changes in operating assets and liabilities. That's amazing. It's basically like working capital liquidation. So to grow again, they're gonna have to reinvest into that. So this is obviously, I'm guessing their inventories went down. And actually, no, inventories. Let me see. No, inventories went down. Yeah, look at that, 14.5 billion to 12.0 billion. That's incredible. That was the inventory, 2.5 billion. There you go. AR actually went up 3.3 to 4.4. So they liquidated inventory. I mean, we've seen it also lines up with the global inventory days available has been. So they restricted production and they worked down their inventory. That's a $2.5 billion tailwind into free cash flow, and still their free cash flow is declining. So this company generates pretty much no free cash flow with cars plus Lathrop at max capacity. That's incredible. That's incredible. Like the stock could be down like 50% right now.
Well, they're investing a tremendous amount in the Tesla semi factory, which is scheduled to go to volume production next year and start production 2025, tooling one line for the Cyber Cab in 2025, volume production in 2026, Megapack factory in Shanghai being completed, the lithium refining factory being completed. So they're investing a tremendous amount of good money.
Well, that would be in capex. That would be in capex. So none of what you said is relevant because their operating cash flows have been flat for 3 years. So the things you listed are capex. Thank you, Mike. So what PE ratio, Meta, do you assign to a company that hasn't grown in 3 years and it's not going to grow next year either, and generates almost no free cash flow?
I think that's too short term. That's like saying, how do you value Amazon's cloud business when they were investing everything into growth, right? You got to look
Yeah.
at where they're spending.
Yeah, sure. Why don't we assume they're going to be as successful as AWS? All right, let's see. Is there anything else here? Hey, stock-based compensation went up. How about that? Record stock-based compensation expense. How do you like them? $2 billion trailing 12-month period. Record depreciation, amortization, and impairment, $5.4 billion. Net income attributable, TTM, GAAP, $7 billion. Lowest in the last 3 years. That's incredible. That's amazing. Adjusted EBITDA about flat for the last 3 years. That's incredible. Got a question about the cash flow statement here. Looking at the net cash used in investing activities, negative 7.6 billion. You're looking at purchase of investments, 15.2 billion. They probably bought some treasuries, I'm guessing, using cash. It's not that important. All right. That's about it. Man, so incredible. I would have never expected this. 3 years of flat operating cash flow and decline in free cash flow, barely positive. Income from operations down 41% quarter over quarter. Wow. Jimmy.
Yeah, I'm very glad to be back. Good to see that stream on the YouTube.
Mm-hmm. How's it going?
Well, I'm anticipating a market downturn. I'm also anticipating quite a lot of other things. I have a lot of things on my mind about what I want to do. But, because my whole perspective has been completely shattered the last few days, I'm just kind of piecing the pieces together and build a
Do you have
coherent.
any takeaways from the release?
I'm still trying to figure it out,
Okay.
to be honest.
Thank you. Come back when you figure it out. I see Fo is here. If he wants to come up, he's welcome. All right. Tesla Q4 earnings missed the mark as full year adjusted net income drops 23%. Tesla reported fourth quarter earnings after the bell on Wednesday that missed expectations as investors looked for a new catalyst to jumpstart the stock. Tesla reported revenue of $25.7 billion versus $27.2 billion expected, up only 2% from a year ago. From a profitable standpoint, company posted adjusted 73-cent EPS versus 75 expected. Operating income coming in at 1.58 billion, missing estimates of 2.68 billion. Tesla said operating income was negatively impacted by costs associated with AI and other R&D projects, as well as lower leverage average selling prices for its current vehicles. The company also said plans for a new vehicle and their production would result in less cost reduction than it had previously anticipated. For the year, Tesla reports a revenue of 77 billion on adjusted full year net income of 8.4 billion, up down 23% from a year ago. Yeah, wow. Tesla energy storage business remains bright spot for the company, with energy deployments expected to grow 50% year over year. That's not going to happen. Okay. All right. We have a number of other releases as well. Stocks slipped and bond yields rose, though both paired bigger moves as early concern that Fed Reserve was growing more worried about inflation got tamped down by Chair Powell in a press conference. Tesla rebounded, Meta dropped on a disappointed forecast, and IBM soared on a better than expected earnings. Meta is so volatile, it's amazing. Meta is positive now. Let's look at IBM. Up 8%, and Microsoft down 2%. and Nvidia is up 1.9% after hours. And Tesla is up 3.4% after being down 4%. So obviously, it's going to change a little bit with the earnings calls. So for the earnings call, yeah, I think it's probably best to end the space, and then I'll listen to earnings call on my own, and then tweet if I see anything useful. Thank you very much, everybody, and I'll chat with you all next time. Take care.